She's not Sally, and I am not cute. More than that, you'll find me in a terrible mood. But just because I'm bad doesn't mean that you're good. My head is too small and my mouth is too big. I wear sunglasses by the size of a brick. Just because you're the doctor doesn't mean that I'm sick. Doesn't mean that she's sick, that she's sick. I'm a bit short-sighted and my neck is too long. My ears were made to understand things wrong. But just because I'm weak doesn't mean that you're strong. She's no good, she's no good, she's no good. So let's talk serious, because I'm curious. Do you really think that I'm the one to blame? Even if we try so hard to not let it fall apart, what remains is smoke without a flame. So don't you dare to call me Sally, 'cause I'm not cute. Be sure you'll find me in a terrible mood. And just because you're bad doesn't mean that I'm good. She's no good. Just because you're bad doesn't mean that I'm good. She's no good, she's no good, she's no good. Just because you're bad doesn't mean that I'm good. Doesn't mean that she's sick, that she doesn't mean that I'm good. She's no good. It doesn't mean that I'm good. I wear sunglasses by the size of a brick. But just because you're the doctor doesn't mean that I'm sick. Doesn't mean that she's sick, that she's sick. I'm a bit short-sighted and my neck is too long. But just because I'm weak doesn't mean that you're strong.
Way down in my homeland, where I played as a child, down in the hot, hot sand.
Just waves rolling in and the trees telling stories to the wind. Silence is but hibernation while all else seems to decay. A place for me to persuade the noise to fade away, to fade away. Listen, why?
Hello, and a very warm welcome to the Single Resolution Board Annual Conference 2024. I'm Susan Carroll, and it's my pleasure to be your Master of Ceremonies today. We're coming to you live in Brussels from the Egg Conference Centre, a once abandoned building that has been transformed into an event location and a hub for creative industries. So I think it's a very fitting place for our theme today, discussing progress and challenges for financial stability in an uncertain economic landscape. The conference will focus on readiness for crisis, building resilience, and dealing with new and emerging risks. Before we officially start, just a bit of information from me about our format and agenda. We'll start the day with a welcome from SRB Chair Dominique Labarrex, who will also launch the SRM strategy, Vision 2028. We'll then be honoured with an opening address from European Commissioner Mairead McGuinness. After that, we'll bring the two chairs of the Banking Union together, Claudia Buch, Chair of the Supervisory Board of the European Central Bank, and SRB Chair Dominique Labarrex for a conversation session. And this will be followed by a roundtable discussion with high-level panellists. After a well-deserved lunch break, we'll split into three parallel sessions: the Emerald Journey, the next phase testing and operationalization, and cooperation around new risks and digitalization. For those of you joining us online, the Emerald Journey session will be streamed, and the other two sessions will be made available via video recording on our website afterwards, as well as a report of the event. At the end of the day, we'll come back here to share our takeaways and learnings from the three sessions before a cocktail reception. The closing session will also be live streamed, but not the cocktail reception. Finally, a hint to all our speakers: we are on the record and we're streaming live via the SRB website, LinkedIn, and YouTube. Now, let's get started. It's my great pleasure to hand over to our host, SRB Chair Dominique Labarrex.
Thank you, Susan, and good morning to each of you. Thank you for taking the time to be with us here today, and it's an important day because it's Carnival Day, and so I see that you've chosen to go to a serious event and not to go to Carnival today. So thank you for joining us physically in this magnificent conference center or online, and your participation is really appreciated. Thank you for that. I hope we'll have a lively day of discussion and debate as we discuss the road ahead, risk, readiness, and resilience. You'll see, no doubt, that we have a packed agenda with top-class speakers. I want to say special thanks to each and every one of our speakers, because without their time, obviously, this event could not simply happen. Let me come back to the title of our event today, because each term matters. The road ahead means we are still traveling towards more financial stability, while there is a number of risks growing and or evolving around us. That's why we, all together, banks, authority, and all the other stakeholders need to be ready, which is the only condition to be able to increase the global resilience of our banking union even more. From that perspective, today is a very important day in the life of the SRB and more globally of the Single Resolution Mechanism as a whole, because we are launching a new vision, the so-called SRM Vision 2028, which is precisely connected to the different terms I have just commented on. Together, we've achieved much these past years, and now we have to evolve, having reached several key milestones. On the whole, Emerald deadlines have been met, and it's a big achievement. The banks have made significant progress to comply with the SRB expectations for banks, and this is a second big achievement. And the Single Resolution Fund has reached its target level of 1% of total covered deposits, and this is a third milestone. With that, now we have to build this new strategy, which is a new step in a more mature SRB. It's a new milestone in the SRM life. The strategy will guide us forward and it will be a process of evolution, not revolution. This vision is a result of a strategic review we initiated of our operations and, in consultation with many of you attending this conference today, we've built, step by step, these new building blocks of a strategy. I would like to thank you for your valuable contributions here. We'll have a short video which will give you a snapshot of this strategy, but let me give you a few highlights immediately. 3 areas are covered by this strategy. The first one is exactly dealing with our core business. Our strategy will focus on the need to further improve our crisis preparedness. We'll develop integrated tools to respond to already known and any potential emerging crisis circumstances. We'll work on crisis-oriented resolution planning with an embedded risk-based approach. We'll review our resolution planning activities to focus more on the operational aspects and on testing banks' capabilities to handle a crisis. We'll also perform on-site inspections. The SRM will work to be the global reference in the resolution field, improve knowledge management, and keep building relations with European agencies and institutions, as well as international relations. The second area of this strategy is in relation to governance. We want to strengthen our structures so that we become more streamlined, more efficient, and more transparent. In particular, towards the industry, and I know that there are many industry representatives today in this meeting room and online. Let me mention already 2 first examples. The first one is last week, we published our calendar of surveys and requests to banks for the whole 2024 year. This unprecedented publication goes exactly in the direction of more transparency and predictability. Another example is the MREL policy consultation we launched 2 months ago. Today, by the way, it's the last day. If you want to answer, please do it quickly, because your answers will help us defining the future of our policy in this important area. Through the second pillar of our new strategy, I also want to reinforce the SRB NRA's integration and build a common culture within the single resolution mechanism. We'll also take advantage of a digital transformation and reinforce the SRM's and SRB's data capabilities while increasing our framework on cybersecurity. The third area of this strategy is focused on human resources, a key component of any organization. We want to harness the potential of a motivated young pool of talent by ensuring more internal and external mobility and career development aspects, while improving staff training. We'll also increase the focus on diversity and inclusion in the SRB. Our new strategy will better equip the SRM to deal, as I said, with its various challenges to ensure banks can be resolved, thus contributing to financial stability. I'm not forgetting indeed about financial stability, that just a few weeks into my mandate, we saw the turmoil coming from the US and Switzerland. Europe has emerged relatively unscathed following that market turmoil which began to emerge almost 1 year ago. That was, this is what I think strongly, that was the dividend of the regulatory, supervisory, and of course of the resolution planning work of the last decade. 12 months on, we must remain vigilant, absolutely vigilant, as new threats emerge from asset quality deterioration to heightened geopolitical risks. But to remain vigilant does not mean that we should not recognize the efforts made already. And so, taking into account these evolving threats, we've decided to reinforce our structure immediately without waiting for the adoption of a strategy. So we've made some changes, and I will give you 2 examples here. First, with my fellow board members, we've built a unit in charge of crisis management, reinforcing the embryo of what we had in the past. And we've created another one on risk management, crisis risk. Clearly, the aim of these new units is to enhance our efficiency and readiness to handle a crisis. More broadly, looking ahead, I also hope that we'll see the approval of CMDI soon, including all its parts. Not because we think that the toolkit is not complete yet. We have an efficient toolkit, but we can do even better. And this reform is an important signal to send a signal of trust into the resolution framework and in the banking union. And we need it now. Ultimately, because we want to be sure that our resolution toolbox is even more complete than it is today. Whatever compromise the co-legislators may find on the CMDI's funding equation, they need to make sure it delivers, let's say, something like a similar result to the Commission proposal. More concretely, what I mean by that is that if the scope of banks under SRB's remit is extended, we need sufficient funding solutions to execute successful resolution transfers. Short of its funding element, the core of a CMDI proposal will lose coherence, and we'll find ourselves facing the possibility of having to resolve banks for which we do not have the right tools. Then, obviously, liquidation, often with the help of taxpayers' money, may become the only option. And this is the one of the past, and we want to avoid it in the future. Let's see how the CMDI proposals advance in the weeks ahead. I'm sure that our panel in a minute will come back to this topic and we'll discuss it thoroughly. Let me now conclude. Today, we gather here in Brussels, and I want to assure you that if we are gathering here all together, it's for, let's say, building together a common understanding of the issues we are facing today. I want to assure you that we'll continue to work hard to continue delivering financial stability to all European citizens at no cost to the taxpayer. Let me come back just 1 second on what Susan said already about the 2 days conference. We have renewed its format for those attending the previous ones who attended the previous ones. You remember that the location here is very new compared to the previous one. And we've changed the format, and you will have panels this afternoon. So it will be very important that you give us your feedback about what you think about this new format to charter the next editions of this conference, obviously, and I trust your judgment here. We have here among us, and Susan said we were entirely on today, because we have a good media contingent today with us, and I think it's important because our journalists are playing here a very important role. They are, if I may say so, storytellers, the ones who have an important role to play to explain, to pass the messages, and I would like to thank them for attending this meeting with us today. Finally, let me thank again our speakers and all of you joining us here and online, and I encourage you to take an active part in the discussion. Before closing, I would like to make an official announcement, which was longly awaited by the industry. I'm pleased to announce, as I said at the beginning of my speech, that we have reached the 1% coverage for the Single Resolution Fund. So that means that I can tell you today that we won't be issuing a request for contribution for this current year, 2024. I think it was longly awaited. It's a very good piece of news for you, but also for us. Thank you very much. Let's enjoy the conference, and now let's look at the short video presenting you the new strategy of the Single Resolution Mechanism. Thank you very much.
With its mission to protect financial stability and the taxpayer, the Single Resolution Mechanism has built a robust and effective framework for preparing for and managing bank crises in Europe. Working closely with the banking industry, the European Central Bank, the European Commission, and other stakeholders, the SRM's stable foundation is crisis-ready and resilient. We have built up the Single Resolution Fund. Banks have met their MREL targets, and our expectations for bank resolvability have largely been met. But we are not stopping there. The SRM is evolving to meet new risks, challenges, and opportunities. The SRM Vision 2028 strategy is a blueprint to ensure we stay resilient and ready for any crisis. Based on our expertise, our commitment to serve European citizens, our collaboration with our stakeholders, our focus on transparency and communication, and as a great place to work. What will we do? Well, among other activities, we will shift from building up resolution plans to increasing our preparedness to deal with emerging risks for stronger resilience in the financial sector. We will test resolution plans and make them operational with a comprehensive plan for resolvability testing. We will continue to increase transparency and will provide clear and timely feedback to the banks on their resolvability and MREL. We will integrate our work in the SRB and national resolution authorities even more, as well as simplifying and increasing efficiency. We will act as an international centre of expertise for resolution and enhance our cooperation with global stakeholders. We will harness digital technology to achieve our mission with a dedicated innovation lab. And we will help our staff reach their potential, as well as improving gender balance and diversity. With clear goals set for the next 5 years, we will achieve our mission of being ready to protect financial stability and the taxpayer with a flexible, agile, and resilient single resolution mechanism.
Many thanks, Dominique. And if you would like to see that video again, which I'm sure you do, it's available on our website and also on our YouTube channel. Now let's turn to our opening address. And I'm very pleased to introduce Mairead McGuinness, European Commissioner for Financial Services, Financial Stability and Capital Markets Union.
I'm very impressed by the high tech, I have to say, and I'm very nervous speaking after a video which was so effective in terms of communication. So firstly, Dominic, thanks to you for the invitation to be here. Thanks in particular for your strong opening remarks. But I think that video encapsulates everything that we need to see, and my best wishes that you can deliver to the plans that you put in place. We're looking at the road ahead here. And I think everyone in this room probably has a different version of what lies ahead. But it's fair to say we all see a lot of risks, a lot of uncertainty, a lot of insecurity. But there's no point in standing still. So we have to address all of those issues, those that we know and those that we are less clear of. I like the idea behind the theme of this conference, looking on that road ahead, but also addressing risk, readiness, and resilience. And I think it's that final, or that resilience piece, which is I suppose, the product of looking at the risks, being prepared, and resilience matters across society, and it particularly matters in our financial system, because we have come a long way since the global financial crisis in 2008. Our banking sector in Europe has shown remarkable resilience, and that is in large part due to financial regulation reforms put in place over the years. We can thank the Single Resolution Board for helping us come this far. And thanks, Dominic, to your leadership and indeed to your predecessor, Elka. We are here today to focus on what's next, and we've had a very good look at what the plans are here, because we do need to think about how we can ensure that EU banks can continue to be strong and support citizens and businesses, how they can remain competitive and face the challenges ahead of us. So I very much welcome the Vision 2028 of the SRM. And I do really welcome the forward-looking approach being taken by the SRB. I'm going to do a little bit of gazing ahead myself into the future. And I'm going to talk about why we need to finish what we started with banking union and what we need to do to complete banking union. I've had to realize myself that sometimes you have to say the same things all the time in order for it to register that we haven't changed our mind about the importance of banking union. I worry sometimes that my script is repetitive, but I make no apologies for it being repetitive, because I think these messages are important, and without progress, we need to understand the consequences. There will always be risks, expected or unexpected. If you look at the world today, we are being buffeted by geopolitical and economic headwinds. We had the global pandemic and we saw the economic impact, but we also saw how Europe was resilient. And indeed, European banks came out of that period well capitalized. But the outlook for profitability was challenging, and banks had many more indebted clients. Then we had to contend with, and are still dealing with, Russia's illegal invasion of Ukraine, which disrupted all sectors. Food, commodities, energy prices all increased rapidly. Together with the combination of the recovery from COVID and remaining supply chain challenges, this triggered a spike in inflation. And in turn, we had a tightening of monetary policy. And banks now find themselves in a fast-changing landscape. Higher inflation and rising interest rates present different challenges to financial stability than low-for-long interest rates. We also have longer-term trends that are transforming our economies and societies. The sector is in an era of rapid technological change, which was massively accelerated by the COVID pandemic, when banking went largely online. It means banks can develop new products and services for customers. But there is a particular risk from cyber attacks that banks need to build their resilience against. It's ever present and will not go away. At the same time, we're ramping up action on climate, making sure that we get our economies and societies ready for a more sustainable future. Our banks have to manage risks arising from climate change, whether those are the physical risks from climate-related natural disasters or the transition risks as we move to a net zero economy. So we hope the road ahead for all of us will be smooth, but we should not rely on that. What we can do is to be ready and prepare for risks. We need to build resilience into our systems so that we can deal with expected and unexpected risks. And that brings me to my point on banking union, which is that we need to do more and we need to strengthen our banking system by completing banking union. We need to make sure that the European banking sector can cope with whatever tomorrow brings. Banking union is about making our banks stronger and more resilient, prepared for the worst if it comes. Now, last year we had a stark reminder, if we needed it, of what can happen if a bank fails, though fortunately, in this case, we were not talking about banks within the European Union. The failures of some US regional banks and Credit Suisse were very stark reminders of how things can go wrong. Now, specific national factors played a role in these cases, as did digitalization in the financial system, which allows for rapid movement of deposits. there's no longer any need to stand in a queue outside a bank to collect your notes. In fact, I think younger people don't understand what a queue would mean at a bank because they don't go physically to banks. But if I look to events in the US and Switzerland, they did not spill over into the EU. There was no contagion, demonstrating EU banks' resilience and sound supervision. But it would be wrong to say that we were not concerned. Of course we were concerned. This episode shows why it's important to continue with reforms to make sure that our banks remain safe and sound, rather than resting on our laurels of complacency. And I know that in this room there is no complacency. Looking beyond preparation for a future crisis, as important as that is, a complete banking union would bring wider benefits too. And sometimes this is not really fully understood. It could boost banks' profitability and competitiveness, allowing them to scale up their activities within the single market. And the advantages would extend far beyond banks themselves. I don't often, if ever, get asked by the man or woman in the street how banking union is progressing. But I do get asked very fundamental questions like, why can't I get a loan in another member state or a mortgage? Why do some banks in other member states offer long-term mortgages with fixed interest rates? And why can't I get that at home? So people do understand that there is a fragmentation in the financial system in the European Union. It's why they ask these very basic questions. And of course, it's not just for individuals and families, but also for our companies that these issues are important. European companies still depend on banks for most of their financing needs, and that's particularly true for SMEs. So are European companies able to compete fairly in the single market if they face different conditions when it comes to banking? And of course, if there's not a level playing field, there are differences. It's clear that the need for banking union is as great as it ever was. And we need to communicate to citizens the concrete benefits of a banking union, like the protection of taxpayers' money in case of a bank failure or the protection of bank deposits. And the banking union also ensures EU's financial stability. Those who remember the great financial crisis know how financial instability can be a long-lasting drag on economic growth, employment, and more generally on prosperity. Now, there is good news, and the good news is that we have made significant progress in banking union, starting more than a decade ago. We have a single rule book that applies across the whole of the EU. We have a centralized system for supervision through the single supervisory mechanism, which does what it was intended to do, supervise the European banking system, and it has worked well in complex circumstances. It took a flexible supervisory approach in response to the COVID crisis. It has also been proactive in tackling interest rate risks in the new macroeconomic environment. We have a centralized system for resolution, the single resolution mechanism, as the people in this room know only too well. If a bank gets into trouble or even fails, then banking union is there to ensure a quick response. The Single Resolution Board and national resolution authorities have made sure that this system works well. It safeguards financial stability while also protecting taxpayers and depositors. So, for example, and thanks to your work, most banks have set aside enough resources to absorb losses in case of a crisis. Alongside this, we have the Single Resolution Fund paid into by EU banks to protect taxpayers' money. And indeed, Dominique, it's great to hear the news that the fund has reached its target levels and indeed has done that on time. Banks have also significantly improved their resolvability, which means that in a crisis they can be wound up or restructured in an orderly way. And this can be done in a way that prevents disruption for the banking sector, all the while safeguarding the financial services that people and businesses rely on from their banks. But there's always a but, and the but here is that we still have a lot of unfinished business on banking union. So given my host here today, I want to mainly focus on resolution. We have a lot of measures in place for resolution, but there is undoubtedly room for improvement. So first, crisis management and deposit insurance. This is about how the EU deals with the bank crisis in an orderly and efficient way, And as you heard from Dominique, we adopted a proposal to reform the rules in April of last year. And we did those rules based on our assessment of how things have worked in practice. It reinforces the two fundamental goals of what emerged as the consensus on resolution after the great financial crisis: safeguarding financial stability and protecting taxpayers. The review is in the works for a long time, so it is not a response to the banking turmoil of last spring. But those events underscored the benefit of strong prudential rules to reduce the likelihood of bank failures. When it comes to our Basel standards and implementation, I'm particularly satisfied that we have finalised all of those details, and indeed that we apply those standards to all banks, while at the same time we use the flexibility in the Basel Agreement to take into account the characteristics of the European Union economy. So again on resolution, for example, how the resolution of a bank is prepared and planned is important. We need to make sure that resolution tools work effectively when a crisis happens. And in this context, I want to acknowledge the strategic review that Dominique has initiated. The SRB, the Commission, the ECB, and the EBA, with national resolution authorities, are working together on the future of the single resolution mechanism, and looking at how cooperation can be strengthened. And we can draw lessons from the US and the UK experience with Silicon Valley Bank. That showed that resolution authorities are well aware of the contagion risks from imposing losses on depositors and cutting them off from their accounts. We have a real-life illustration of the impact on the economy and on market confidence. And we saw what potential bank runs might look like in this ever-digital age. We also witnessed how the US authorities use the tools they have in a flexible way to deal with those cases. Now, it's true that Silicon Valley and Signature Bank were outliers with a very high concentration of uninsured deposits. But we observed a similar reluctance to impose losses on deposits in Europe over the past years. Your average citizen's deposit could be well covered by the deposit guarantee up to €100,000. But over €100,000, those uninsured deposits, may belong to public service providers or educational institutions or indeed local businesses. It is a tough political decision to impose losses on them and put their access to banking services at risk because of a bank's failure. And this is one of the main reasons that the failures of smaller and medium-sized EU banks have often been addressed outside the EU resolution framework, often using taxpayers' money instead of making investors, creditors, and the banking sector itself pay for the failure. So our proposal aims to broaden the scope of resolution and the use of EU resolution tools. But this does not mean that all banks will be resolved. That was never our intention. Instead, we wanted to better frame the criteria for resolution authorities to decide how to proceed, whether a bank should be resolved under harmonised EU rules or liquidated under national insolvency proceedings. But resolution authorities will continue to be able to make their own assessment and use their own judgment just as they do today. And they will ensure that they can use the most appropriate tools, whether that's resolution or not, given the circumstances of the bank in distress. We took national specifics into account and kept the continuum of tools intact with precautionary recapitalisation, preventative and alternative measures using deposit guarantee schemes, resolution and national insolvency. While at the same time, we have to frame the system in a way that ensures legal certainty and a level playing field while protecting taxpayers. Another important lesson is that shareholders and investors must carry the burden of a bank failure. And this is actually what happened in the US. Additional funding to support the sale of valuable assets and deposit books came from the US Deposit Insurance Fund, which is now being replenished by the banking industry. The crisis management and deposit insurance reform also aims to enable resolution authorities to shield depositors from losses if they consider it necessary. For this purpose, Deposit guarantee schemes and resolution funds could be used more efficiently to manage a bank crisis instead of using taxpayer money. Shielding depositors better may be even more important today as digitalisation increases the speed of bank runs. The first line of defence is and must remain the internal resources of the banks. Those who decided to invest in a bank must be the first to pay for its failure. And in fact, US authorities have confirmed that outcomes would have been better with resolution plans and loss-absorbing buffers in the affected banks. So this confirms that the EU's decision to apply resolution-related requirements to a broader range of banks is a good one. But when it's more efficient and justified by the public interest, the industry-funded safety net should come as a second line of funding by facilitating the transfer of a failing bank to a sound buyer or a bridge bank. Economically, this kind of transfer strategy has proven the most efficient at maintaining access to deposit accounts, fostering depositor confidence, and reducing the incentive to run. In those circumstances, the failed bank would exit the market, and shareholders and investors would bear the losses. I want to thank the SRB, the ECB, and the EBA for their valuable support for our proposal. The European Parliament and the Council have been working hard to agree their positions on the Commission's proposal, and so far good progress is being made, and I hope that that will continue. I welcome the Belgian Presidency's ambition to find an agreement in Council before this summer. It is important also that the Parliament adopts its own position before the elections, which loom large. This would allow trialogue negotiations to start soon after the new Parliament returns post the elections. I think this timeline is doable, but I acknowledge that everyone will have to work particularly hard to meet it. Finance ministers have committed to adopt the CMD reform this year, and they committed after that to come back to the unfinished business of banking union. And here the big one is, of course, the European Deposit Insurance Scheme, EDIS. We need EDIS so that all depositors are equally protected, no matter where they are in the banking union. And then beyond EDIS, we need to think about appropriate rules for banks' holdings of government bonds. And then there is the question of how we make the most of our single market for banking. More integration across the single market. This is key to providing better banking services to both citizens and businesses, and to help EU banks be more competitive globally. There is a close link between banking union and capital markets union, and as you know, we are working hard on both. Our banks play an important role in key segments of capital markets, like trading, investment banking, underwriting, treasury, or depository services. Banks are also key players in helping people save and invest for key milestones in life, mortgages, buying a house, or indeed pensions in retirement. So integrating our banking markets go hand in hand with deepening our capital markets. A complete banking union can help the development of a truly integrated EU capital market by facilitating the emergence of more banking groups that provide financial services to companies and investors across our member states. A genuine capital markets union can also give EU investment banks the scale to develop their activities in a profitable manner and compete internationally. Banking union and capital markets union are mutually reinforcing projects, and in one sense, we can't really have one without the other. And we all agree about the need to make urgent progress in building a true banking union and a true capital markets union. And I think the time is right and the time is now, because we do need to be bold and tackle all the obstacles that have been put in the way on the road ahead. And that means removing barriers to the free movement of liquidity and capital. It means facilitating bank consolidation, making progress on our proposals on insolvency rules and withholding tax procedures, putting in place truly European supervision. A single market for banking and capital would never be a threat to financial stability or take away opportunities from people and businesses. In fact, the opposite is true. After all, a deepening capital markets union will strengthen the resilience of the banking sector to economic shocks by delivering increased private risk sharing across member states. And finally, we must also finalise the implementation of the ESM backstop to the Single Resolution Fund. This is an important piece to make our crisis management framework truly effective. This treaty was ratified in all but one national parliament, and that speaks to the commitment of euro area countries to strengthening the banking union and to ensuring that citizens and small businesses are protected in a bank crisis. Without the ESM backstop, we're missing an important tool to help protect households, taxpayers, small businesses from the costs of a major financial crisis. Indeed, without the ESM backstop, it's also difficult to talk about liquidity and resolution, another element that requires new focus. As shown by last year's US and Swiss bank failures, providing liquidity funding to an institution in resolution is key to stabilising that institution, swiftly restoring market confidence and limiting contagion. Reflections on this are ongoing internationally, and we will certainly come back to this issue. It's regrettable that this element of banking union is still not in place, and it could hinder progress on other parts of the banking union agenda. The best way to ensure a resilient European banking sector that is future-proof is to complete banking union. And we have come a long way already, but sometimes the last steps are the hardest. And we've come a long way due in large part and thanks to the work of the Single Resolution Board. But we still have work to do, and I think it's really important that the message goes out loud and clear that the time to build resilience against risks, those we know and those we don't, is now. It's not when those crises hit us. Thus far, we have been well prepared because we learned from the financial crisis. And I think we need to keep that same level of readiness and resilience to all of those risks that lie ahead. But the vision for 2028, in my view, is an excellent starting point. So thank you for that, and thank you for your attention.
Thank you very much, Commissioner. I think you have set the scene perfectly for our discussions today. Now let me invite to the stage our two chairs, SSM Chair Claudia Buch and SRB Chair Dominique Labarrex, with moderator Maria Tadeo for our in-conversation session. Please. How are you doing? Thanks.
Well, thank you very much, and thank you to the Commissioner who really laid out the many challenges in a very concise way, and thank you to the two chairs for this conversation. It's a great conversation, very timely. Also for Madame Buch, I believe that this is your first big trip to Brussels in this new capacity, so obviously I'm sure a lot of people are very keen to get to know you in more detail. And to start the discussion, I had an obvious question. When you look at the banking sector, when you look at the banking union, we're going to go in detail on that. Overall, how well functioning would you say it is in 2024 when it comes to Europe and serving Europeans?
Thank you very much for the question. Thank you very much, actually, Dominique, and to your whole team for having us here. So if I would cast a vote, I would always already vote in favor of this location also for the next time. It's very good to be here. So on your question, is the banking union working? And I think we've just from the Commissioner, we've basically heard it all, but let me just say it a bit in my words. And I think the issue is that we've seen, I mean, notwithstanding the shocks and the risks that we've seen over the past years, but we've really seen a resilient banking sector. So the banks are better capitalized, they're liquid. The cases that we've seen where, banks came under stress, we had a system to deal with these cases of stress. And I think if you have a situation like this, it's sometimes forgotten how it would look if we didn't have all these, new regulations, new institutions. So if you just think back, how it looked 2007, 2008, when the global financial crisis struck. We didn't have harmonized supervision across Europe. So we had basically, of course, the same rules also coming from Basel, but we had very national supervision. we didn't have any resolution tools, resolution policies, a single resolution fund. I'm not even sure whether the term had been coined at the time. So what we could do, or what in the end policymakers had to do, is to really intervene into the financial system, to bail out the banks, to spend fiscal money that could have been used for much better purposes, to use it to stabilize the banking system. One reason was also, and that hasn't been mentioned so much, we didn't have macroprudential policy. I mean, it's not a term which, not a household name necessarily, but it basically means we didn't have any tools to deal with systemic risk in the system. And all this has changed. It has changed because a lot of policy decisions that we're taking in Europe, here in Brussels, why I'm particularly happy to be here. But I think it's always good to remind ourselves there was also a very strong international policy response to the global financial crisis. So the reforms that were put into place, the elements that were defined and that were then implemented, this all came also from the G20. The Financial Stability Board did a lot of work here. So, and actually, if, again, you think about what good this has done for the society, for the financial system, for the stability, you can actually look at the many studies that have been done by the Financial Stability Board, including on too big to fail, saying that we have a better system, we do have resolution policies. We also see evidence that the incentives have improved in the financial system. So smaller implicit government subsidies for the financial system. So all this is a big success. And in that sense, the banking union is working. And I think we also come to the gaps, but I just wanted to send a positive message first, and then we can discuss all the gaps. And I very much agree with the Commissioner, what she has said.
Certainly, that will be the follow-up question. But before perhaps also get your take, Monsieur Labourex, on this.
Well, I can confirm very simply what Claudia just said. If we look again at where we are today, comparing the situation of today and 10 years ago, to the question, have we made progress? Is it working? Yes, the answer is yes, obviously. We've built a big amount of resilience because we had agreed, not us, but the co-legislators, on strong regulations applied to everybody, not limited to big banks only. When I compare the situation with the US one as an example, with proportionality, obviously, but still, so strong framework, strong supervision with a harmonized approach, strong and very new resolution framework implemented from scratch in less than 10 years. So yes, it works. By the way, it works, and we've demonstrated it with the small, still small, but this is good news in reality. It means that there are resilience in the system in Europe, but the small number of decisions we've taken, which were successful. Banco Popular, Sberbank, Banco Popular in 17, Sberbank in 2022, two completely different cases. And in both cases, due to the good cooperation, good preparation, all the steps taken during the last years, it worked. So to those who are telling me, yes, but are you sure that it's working? Yes, the answer, yes, it works. It can work even better. And this is exactly what Marian McGuinness has insisted upon, that saying that we can indeed continue to close the gaps and to continue to be ready. And this is let's say, this idea on our side this time. With what we have today, we need to continue not to be complacent and to really be vigilant to improve our preparedness. So preparing the preparedness, but adding the elements which are missing, still missing, can even improve something which already works. This is, I think, the good approach to understand where we are today.
So you both have made clearly a case for the banking union. You both say it works, and you also say when you look at it objectively from 10 years ago, it is manifestly, or could be manifestly proven that it has worked. We're better off now than we were 10 years ago. So then my obvious question then as a follow-up, if it works so well and is so good, why is the banking union not moving forward, certainly not as fast as expected? It seems it hit a political wall and it cannot move beyond past a number of dossiers. So what happens next?
Well, I think one explanation for this, why are we not moving more, is, I mean, basically what I've mentioned already, that there's important, relevant elements of it which are actually working well, and we all know how it is in our daily lives. So if things are going well, then the initiative and the energy to change things and to go another step are sometimes diminished a bit. And this is, I think, why it's so important, and also what we heard in the speech, that actually the times that lie ahead of us. So there's a lot of uncertainty geopolitically. We're in a very new macro financial environment, and we still, I mean, so far the banks are dealing well with it. We're seeing higher profitability, but all this is no assurance that it will stay like this. So we need to be very vigilant. We have to make sure that the whole system, the banks, each and every bank is well prepared, but also that we are well prepared. And as Dominique said, there are gaps still in the resolution framework. It's not saying that it's not working as it is, but there's things we can improve, and that's, I think, is also quite natural. So when the regulation was drafted the first time, everybody did his or her best effort, and now we're finding that there's areas where it can be improved. And this is, I think, why the CMDI file is so important, because I think it will make sure that more banks are resolvable, that the necessary funds are there. This will have, again, positive implications for financial stability. And I think overall, the more credible the resolution regime, maybe the less likely it is that we actually have to use it, because that will also change the incentives in the system. So I think these are relatively straightforward steps. I really hope that this CMDI file is negotiated, discussed, and agreed relatively soon, because we really need this.
And Mr. Labourax, on that point, the banking union obviously has to be completed. Everyone says it has to be completed, but it moves very, very slow. Some would actually say momentum, in fact, has been lost. How would you counter that?
Well,
if it can be countered.
When you say that it's moving slowly, again, let me repeat, in particular on the resolution side. 10 years ago here in this European area, there was nothing on resolution, crisis management. The only ones in charge of crisis management at that time were supervisors. I was among those at that time, and we were managing at the same time the daily supervision of banks and thinking about potential crisis solutions. So we've built from scratch something completely new, with new concepts, a new framework, and we've started to implement it. So when you say it moving slowly, let's take the distance. The FDIC was created in 1933. So 90 years ago, 90, near to 1 century ago, we have created the resolution framework 10 years ago. And here there are two things which are always mixed up, and by the way, I just made it. We are mixing the framework, which is available to all the European Union countries, member states, including the ones who are not members of the banking union, and the banking union. And when we think along these two lines, I think we have two avenues. What is missing, still missing in the framework applicable to the European Union, and what is missing in the architecture for implementing this framework within the 21 countries who have decided to be part of the same banking union. And if we go along these two avenues, on the first one, the framework, I think Marin McGuinness said it very, very nicely, no need to repeat, you confirmed it, Claudia, we are entirely aligned. We need first to make some improvements, starting again from a good starting point, but we can improve it, CMDI. We've insisted already a lot on the core of the proposal, which is more regionally systemic banks for resolution than, let's say, increase of the solutions potentially usable for successful decision. But there are plenty of other elements around this core proposal which could help and ease the implementation of a resolution decision. So CMDI is one. EDIS, don't call it EDIS if you don't like EDIS, but this interconnection in a way or the other between the DGSs is absolutely crucial for completing the banking union, and even beyond the banking union, we also need to develop the capital market union. On the ESM treaty revision, this is specific to the banking union this time, and it's very, very needed to have this additional safety net to give more trust in our capacity to act. So on the framework, we have a number of things to do, but still we have achieved a lot. On the banking union itself, I would like to tell you that it works very well already on a daily basis. We are cooperating on a daily basis. There are here representatives of members of the teams we've built between SSM and SRM. We are communicating all the time. We're exchanging views on, let's say, normal cases and even on stress test cases, crisis times, preparing for decisions. We are working all together, and I would like to give you one or two examples of this good cooperation. We are visiting all the banking union member states together with Claudia and with your predecessor, Andrea. We've started last year to show that the banking union is a reality. It's not something, well, it's a reality. We are working together. We know each other. We are calling us every day, or more or less every day. We are sending us textos. We are working together. That's important to notice that. We are developing common templates, and you know, bankers, that there is this very good example on liquidity. Liquidity is a topic which is growing and growing as a risk today. So that's why we have this common approach. We have even developed new approaches for organizing exchanges of staff members between the two organizations to build this common culture. And we have started this year by sending different persons from Brussels to Frankfurt and from Frankfurt to Brussels. So, I mean, on our daily life, we're working together. The two pillars of the banking union are in place, working together. We expect to have a third one day or the other, but already the two first ones are working very well together.
And on that note, just to wrap on this issue, however, because you both have said, based on the way that I understood it, that you believe the banking union is a good thing, it is needed, and more work should be done. However, you know there's a number even of banking executives at times who say practically it is hard, something like EDIS, the political will is just not there for it, and maybe it would be better off to leave this aside and focus on areas where you could see material progress fast to strengthen the union. That may be the capital markets union. I wonder, is that an approach that you think is valid? Or actually, when you look at it, you say, well, it's Europe, everything is a package, and nothing is agreed until everything is agreed. How would you go about it?
I mean, let me first come back to the question of what are the gaps, and the gaps have been mentioned. So we mentioned CMDI, EDIS, liquidity and resolution, the ESM backstop. And I think one of the things that's perhaps sometimes a bit difficult to communicate, or where we have to do more, is that the idea is not to have all these funds that are available in resolution and in difficult times to actually use them. I mean, this is maybe a bit counterintuitive, but actually the more credible resolution is, the better we can threaten that in case, you know, a bank does not make it, a bank is failing, then we can deal with it. That, I think, has very important implications for the banks and for the risk-taking incentives in the going concern. So, of course, I mean, we as supervisors, we have to make sure that banks have good governance, good risk management, and all that, but we can't all bank failure now and forever. You know, there might be external shocks, and also we can't ultimately control what exactly bank management is doing. But we can make the probability of failure and the probability and the loss in case a failure happens, we can make that smaller. But all this, I mean, setting the incentives right in the going concern depends on that the banks also know credibly that we've heard about resolution planning and all that. This system needs to be credibly in place. And I think if we make this even more clearer and explain this, why it's so important to have all these funding facilities in case of resolution, maybe that will also make it easier to come to an agreement on these things. So we have very strong safeguards also when you look at the CMDI proposal. There's very strong safeguards as to when deposit insurance funding can be used. So I think there's a lot of maybe also sometimes misperception, or, you know, where we have to improve our communication about when are these funds going to be used. There's strong safeguards in the system. You also asked about all the other things that could be done to you know, enhance cross-border activity of banks. And let me say that actually I think CMU, so Capital Markets Union, is a very strong complement to all these initiatives, because there's a lot of very relevant aspects in this file. I just mentioned insolvency regulation, where it would be much easier also for the banks to do cross-border activity if they were dealing with not exactly the same rules, because we have differences in legal systems, but if they would be dealing with at least some harmonized set of rules.
And just to answer the question, maybe it's time to focus on things that are more actionable in the short term, or do you still believe it's a full package? This is not the time perhaps to give up on a part of it to focus on another.
I wouldn't give on any of these elements that we've been discussing here, but I think, we really need then to think about, I think, CMDI. I think it's a good package, and that needs to be passed. More work certainly has to be done on EDIS. I think EDIS is also crucially important, but I would do CMDI is really a priority. EDIS is important, liquidity and resolution, and then there's all these other files that are out there in terms of capital markets union. And we also need to make progress there, also because we need to finance the green transition, and that also needs a lot of long-term funding. It can't all come from the banks because there's a high uncertainty, and it's long-term investment that is needed. So that is, I think, the big political narrative also why we need the CMU.
And which is an excellent point that also both companies and banks say the need for funding is so huge, but the model as it stands may not be able to provide for all of that. It was maybe not made for that.
Well, this is why we typically have a good funding mix, no? Bank lending and equity finance, and there are many business cases where we need equity finance rather than bank lending when it comes to financing the green transition.
And I have a question for you both. In particular, I know, Madame Book, yesterday you put out a publication where you talked about the risks ahead and almost your train of thought in terms of going forward, building resilience, but also things that could go wrong too. You just said a supervisor cannot prevent everything that is bad won't take place, but it can reduce the possibility of it manifesting. So I wonder, a question for both of you, in fact, when you look at 2024, the medium term, what are the risks that concern you? Are there new risks? Is the nature, even in banking supervision, changing? How would you say you approach this, and what concerns you at this point? Perhaps if we start with Monsieur Laborex first.
Well, Claudia is better placed than I am to speak about the current risk she is supervising with her teams. I think we agree on this very new feature, which is this sort of let's say, acceleration of the risk we are meeting. This is something which matters a lot for us, obviously, on the crisis management side, because what we've seen in the recent cases is that due to market pressure, a bank was able to collapse in a very few days, coming from, again, digitalization, which gives the possibility to organize a bank run very quickly, social media pressure, etc., etc.
That's a great point.
That means that for us, beyond the very classical risk, and I will let Claudia mention them, which are very serious, by the way, but classical credit risk, there are new elements which can threaten our level of preparedness. And I would like to insist, coming back to what Claudia rightly said about the need to make progress on everything. You said, is this something more pressing than something else? I think we need a lot of emphasis, because we need this flexibility, the toolbox, the full toolbox, to be able to address these new risks. The resolution framework, in particular the resolution framework, is coming from the analysis of the past crisis, that's to say 2008, 2009. And so in this past crisis, you remember very well, the source of the difficulties were essentially credit risks. So hidden losses, bad management of credit risk portfolios, and then, difficulties. So essentially the framework was built on that one. The recent cases are telling us that the sources of the crisis can come from something completely different. Sberbank in 2022, sanctions taken by the EU member states against a bank whose, let's say, interests were owned by Russian oligarchs who were under the sanctioned lists. And then the bank failed in less than 1 week due to this sanction. Was it a question of solvency? Absolutely not. It was something linked to operational risk, reputational risk. What we have seen, as I said, in SVB is this sort of possibility to have an immediate pressure coming from real or fake news, we don't know, but creating a pressure for a bank run. So we need to adapt ourselves, and that's why, for me, not only there are these traditional risks, but there are new ones coming. I don't want to insist a lot on cyber, but cyber creates in itself new types of risks, new types of answers will be needed. I know that there's a stress test to be organized by you and will be part, by the way, of this exercise, but I let you compliment.
And you also, if I may say, you brought up the idea of social media, and that was for some very apparent in the case of Credit Suisse, because that was a bank that had passed the stress tests. Even hours before UBS had to come in, they still insisted the bank was solid and was operational, but it got caught in a very, to me, was very surprising as a journalist too, it got caught in a very negative zeitgeist that was amplified hugely in velocity in terms of the content, the narrative around it by social media. And that never stops, not even when the market is shut. So is that something that you factor in? You say it's new, it's strange, it's very difficult to control. How do you go about it?
Well, if you ask me, can I control the social media? You know the answer. Huh? Obviously not. We cannot control them. And it's certainly good news, by the way. Huh? Let's consider that they can bring value to the system, to our democracies, but they are also bringing some new risks, obviously. Huh? And so, regarding social media impact, so well, when we analyze, and some academics have started to study what happened in particular in SVB and Credit Suisse as well, we need to be careful in analyzing. It's not necessarily because you're connected to one of these social media that you will withdraw immediately your funds from a given bank. We've seen an enormous amount of stickiness in the deposits in the European banks in March 2023, despite all the social media noise around the crisis is coming, everything is collapsing, etc., etc. So we need to be a little bit careful. But what this implies, and coming back to something what Claudia mentioned a minute ago, it implies certainly from the banking system itself to pay due attention to this new potential source of reputational risk, and perhaps even more than what they are doing today, by being ready to, let's say the truth at the right moment, and counterbalancing the potential effects of bad social media elements could be something on which bankers should work even more. I know that they are doing it, but I think there is a part of the answer. The other part is for us. We are not equipped to be on the social media full time and disseminating 24 hours a day tweets and other things like that. But what we can do definitely is to show a coordinated communication, and this is important on both ways. Communicating at the right moment, peaceful time, crisis time, and this is part of the strategy, to communicate better, more transparently on what we are doing, what we are preparing, and coordinating between the authorities. And I think I give you the famous example, famous for the small community, in March 2023, when Credit Suisse AT1s were hit by this decision of absorbing the 16, 17 billion Swiss francs of AT1s. We decided EBA, ECB, and SRB to publish a common press release to say, sorry, but here in Europe it won't work like this. And it had an immediate impact to counterbalance the fake news or whatever, or the rumors, to say, no, look, here we are ready to act in this way, not in that way. And it was extremely effective. So this is a good example of coordinated communication at the right moment.
Because the product is back. It didn't die. Some said that it would die, and it certainly did. And so I guess it also speaks to that, the communications around making this is not a European EU jurisdiction problem. But I wonder, Chair Book, to go back into the idea of risk, which perhaps is not always negative, but you have to deal with it. That's basically your job at this point. The playbook for the head of a supervisory board at this point, what does it look like? Because these are complex matters as it is, but yesterday, again, in this communications that you put out, you also talked about the huge geopolitical risks that are playing into all of this. Measuring that is incredibly difficult. On top of that, we've talked about some of the distortions that sanctions also provide. All of this put together, how do you go about this? Because it seems to me it's getting bigger and bigger, the portfolio that you have to attend to.
That's right, that's right. We have to look at a lot of different issues. And let me maybe just make two big points, because you said geopolitical risks and measurement. I think one issue that we all have to be aware of is that we're dealing with a lot of uncertainties. And we know that if we're in an environment of uncertainty, some have even called it radical uncertainty, but that simply means that it sounds very radical. But what it means is actually that we don't know exactly what's the particular event that could happen, what's the probability that we can assign to it, and what's the, in technical terms, the loss given default if one of these events hits. So I think what we have to be aware of, and we're also working very closely with the banks, is that not everything that we are interested in and that we would like to address can really be squeezed into a classical risk model. So we have to work with scenarios. We have to make sure that we have a very good understanding of what's happening at the macro level and the aggregate numbers. How does it break down to the individual bank? So that's the one part of our answer, that we, with all the different issues, uncertainty, risk factors that are around us, we need to be very clear that we can't measure all these things, and we also need sufficient buffers, again, to ensure, for instance, against cyber attacks. So this is nothing we can, it's not only capital that's important here, but it's also IT resilience and all that. And the second point, and basically Dominique said it, we do have a new environment, and I don't have to give all the elements of this here, but we need to adapt to this new environment. So we have very, very good teams, we have very, very dedicated supervisors, and the system is really working very well. And now I think we need to look ahead and think, and this is also what all the banks here in the room also have to do, to think about to what extent will the new normal look different. And maybe we'll never reach a new normal, but we will be in this situation where we keep facing new threats and new situations to deal with. How different will that look from the recent past? And the recent past, again, we had severe shocks, COVID, the Russian war against Ukraine. I mean, these were shocks that hit our economies and our societies already. But if you look at what happened to banks' balance sheets, because we had a lot of fiscal support and we also had accommodative monetary policy, the balance sheet of banks, luckily, were not hit by these shocks so much. But this is, of course, makes it difficult to do the risk assessment going forward, because we can be relatively sure that with all the constraints also facing fiscal policymakers, they won't be able to give the same type of support within the same magnitude to the real economy. So there will be more fragilities also that may hit the banking sector. And also the liquidity environment has changed. I mean, central banks have moved from QE to QT, so from quantitative easing to quantitative tightening. That means liquidity risk management is much more moving to the forefront of our work, and also the work of the banks. And we're doing, of course, a lot of work working with the banks on their funding plans, on their liquidity planning. And
on that front, you obviously mentioned the changing monetary policy. I'm not going to ask you what the ECB will do in March and where that's going, but it's obvious now that interest rates, to some extent, have peaked, and the question is what happens in this new scenario. For banks, that is now the story. The idea of higher rates and benefiting their business model can only last so long, and some would say it's not even a real business model, that cannot be your business model. But how do you think this is an area that can be well, managed in the context that monetary policy does have an impact on financial institutions, and it is changing and will change this year. That's not a secret.
Yeah. And even if you may ask, I wouldn't answer any questions on monetary policy, so that's easy. But I mean, the interesting part of the story is if you look back like the past 1 or 2 years, we had a major increase in interest rates. So I think in most of the models that we've been using, that would have been an adverse scenario. So you may say the adverse scenario of some of our stress test analysis has become reality. And of course, the impact effect on the financial institutions has been positive in the sense that we're seeing higher profitability because of higher interest rates. High interest rates, of course, were the response to higher inflation. So far, I think the system has been able to deal quite well with these higher interest rates. But what it means in the longer term, so we've been discussing deposits, so far we haven't seen a pass-through of higher interest rates onto deposit rates as we've seen it in the past. So that remains to be seen, how depositors would behave, whether they would move more from sight to time deposits, which would increase the funding cost of banks. What the higher interest rates also do to the corporate sector, because we have, I mean, this is not a general issue for the corporate sector, because also many firms are quite solid in terms of their funding situation. But of course, there are pockets of vulnerability, in particular, if high interest rate exposure, high debt, plus exposure to higher energy prices comes together. So these are the things we're looking at very closely. So what I want to say is that we have seen a significant increase in interest rates, and we need to understand collectively how this feeds its way through the financial system.
And can I just ask you just very briefly, obviously, since there's bankers here, and I'm sure they want to hear this from you, it's February, obviously, it's that time of the year. Just to get to know you a little bit better, when you look at maybe remunerations for bankers and so on, is there a line that you're going to take as the chair of supervision? Is this something that you're actively thinking about? Because it is part of your duties at times if you believe something is excessive or not. So how would you go about that before we move to the next part of the debate?
Well, I guess, our policies are very clear. No, we have clear capital requirements for the banks. We have quantitative and also a lot of qualitative measures. We haven't been talking much now here about governance and business models and all these things, but we have very clear guidance, expectations, capital requirements for the banks. But then, of course, each and every bank, each and every manager has to consider what are the risks lying ahead, what preparedness do I need for my institution. So this is a decision that we can't take for them, and that also means looking at the capitalization, the management buffers you want to have, looking at IT systems, what is the resilience of the IT systems with regard to cyber risk. So I think this is actually at the very current moment with good profitability numbers, it's a good opportunity actually to build resilience, and this is also my encouragement for everybody who's taking these decisions to bear that into mind.
Well, you made that message clear. Mr. Labourex, you talked about the coordination that you have with other European institutions. In some cases, that was, not the reality. There were a lot of silos and communications was not as good as it could have been in some crisis situations. How fluid would you say it is now? And when it comes to, the financial sector and the banks and the entire ecosystem around it, there's usually some tension between the regulator, the supervision, and the other side of the equation being the banks. How fluid is all of this in 2024, would you say, and what can be improved, if anything?
Well, let me say that by essence, to ask bankers to pay for their own potential resolution is not an obvious message to pass. And I must say that the communication is necessarily a difficult exercise. So, the equation we try to show is that indeed by increasing the resilience at a cost, obviously, in reality we make the crisis remote, and this is exactly where this resilience has a positive price, and it was acknowledged in March 23 when the crisis stopped at the borders of the banking union and more broadly the European Union. Well, perhaps there were other explanations, but at a minimum this one is extremely relevant. So in terms of communication, when we launched the strategic plan, we launched a survey regarding the industry, and we received exactly the three main messages. You are not transparent enough, so we don't know what you're doing. You do not associate us sufficiently well, and we receive your letters asking this or that, and you don't let us sufficient time. So to implement what you want. So okay, building on these three things, you're not transparent enough. Well, we try to be more transparent, and as I said, we've published last week all the request surveys, etc. we will organize during this year. We are offering today the possibility to have exchanges, and we want to continue to be more transparent on our topics, which are obviously of a lot of relevance for the banking industry. You don't give us sufficient possibility to react, to be part of your thoughts. Okay, we've launched this MREL survey. We've let 2 months for collecting answers and to analyze them, and we promise to continue with other consultations on what we are doing, and we'll have other formats to be sure that we can discuss together about these topics. And you don't let us sufficient time to implement, as I said, with this publication ahead of what we expect the bankers to do in 24. This is the beginning of an answer. In a nutshell, I want to increase the relationships with the banking industry, because it's important to understand that the so-called resolvability, sorry for this jargon, means in reality a lot of work for the banks themselves, also for us obviously, but for the banks. And coming back to what something Claudia just said, with this high level of profitability, that's the right moment to think long-term in terms of investing sufficiently in IT systems in particular, to be ready to deliver on our expectations for being ready for resolution. So again, it's not an easy way of thinking to say, well, why should I spend money for my own potential crisis failure? That's the best way to avoid it in reality, and that's why we need to have this strong dialogue to improve our common understanding around these notions. What we are doing is exactly increasing resilience, as the title of this conference says. Increasing resilience means to have a strong and, let's say, shared dialogue between the industry and us to be sure that we are on the same page.
And Chair Book, how about you? Because from where you sit in Frankfurt, obviously you have to work with these institutions and they have to work with you, but inherently there's always a tension between the two, and you have to watch out for rules that are applied and have them applied efficiently, but banks also say, I have to do that while also making money. So it's at times a stressful relationship. How would you say you plan on approaching this? What kind of communications do you want to have? And as it stands, and obviously you took over from Ms. Enria, what legacy do you have in terms of the fluid communication with institutions?
Okay.
Did they welcome you? I guess that's the question, openly saying, yes, let's work together.
Well, that's, you have to ask them. So far, I think our interactions are very good and positive. So also in the process of getting to know each other, of course. I mean, I think there's one important element that you mentioned that was very high on Andrea's agenda, and it's exactly what we are doing now, and what is also my priority, namely to be very transparent about what we're doing. So like you said, it's, I mean, quite natural that the supervisor and the bank that's being supervised don't always have exactly the same objective function. This is perfectly fine. This is why we are there. So we also have to take a bit more of a longer-term perspective. So we know that a lot of decisions are also driven in banks, are driven by short-term risk responses to market development. So we have to look through these shorter-term trends a bit and really look at also the sustainability of business models in the longer term. This, I think, in the end, is also in the interest of the banks themselves. So there's areas, of course, where we also have to consider more what's of interest for the society, whereas the bank, of course, has to look at its own shareholders. But we need to be very transparent about what we do, what our objective function is, what we expect from the banks, what is our supervisory guidance. And if you look, for example, what we've done now in the area of climate change and environmental risks, I think we've set out very clear expectations, supervisory guidance. We follow up upon these expectations so that the banks know exactly what we're looking for and why we're doing this type of work, not because we want to replace climate policies, but because climate risk is a real and material risk for the banks in terms of transitional risk and physical risk. So here we're working with the banks, and we also set clear expectations, and we also say, well, look, if these expectations are not met, then we will also use our different supervisory instruments to actually enforce the decisions. I mean, this is only always the ultimate instrument if we use, for example, sanctions and penalty payments. But this is really the guidance, the transparency that we give to the banks.
And that's a very good point, because and this is, in a way, some of the tension at times that you see to when it comes to the banks and the regulator. You just mentioned, for example, climate and how to apply that into supervision and regulation. Some would say it is making the field too crowded. The ECB actually does not have a mandate for climate. Its mandate is to, well, have price stability and obviously look after banks in the transmission of that. So all of this makes supervision perhaps too crowded, and it's not helping. Would you say that approach is wrong? Ultimately, risks in the future will manifest in different ways, so you have to also look into this. Because you know the critics will say, you put too much on the plate.
Yeah. No. I mean, we're acting exactly within our mandate. So there's very good supervisory reasons why you want to deal with climate risk and transitional risk, physical risk. So there's an interesting survey we did, and we're actually now repeating it, asking the banks, how well are you able to deal with novel risks that lie ahead? And this is the whole spectrum of geopolitical risks, so things that are that weren't on the radar, let's say, a few years ago. And one of the elements is climate and environmental risks, and most of the banks that we asked didn't have an appropriate monitoring system, I mean, very basic data infrastructures in place to deal with these risks. And this is exactly where we start. So it's not like we want to impose our own preferences as citizens onto the banks in terms of climate policies, but it's rather saying risks are out there and how are the banks dealing with them. And since these are novel risks, there's more discussion that is needed on what do the banks need, what information systems do they have in place. And these are actually areas where we do find deficiencies, not only with regard to climate, but also we find other deficiencies in the internal information systems of the banks. And that's exactly where we follow up. And this is at the core of our mandate.
And Mr. Laborex, would you agree with that? Or do you sometimes see the flip side, that perhaps supervision is doing its job, but maybe extending its mandate a little bit too much? Obviously, from where you sit, I guess that's not going to be a yes answer, but
no.
I have to ask you the question.
You should not ask me the question, because I was a supervisor before becoming the chair of this institution, so I think a good involvement and understanding of the supervisory issues. What Claudia is telling us is that we need to think long term. We need to look forward, and this is exactly what we ask bankers to do: capital planning, envisaging the unexpected elements which can threaten their business model, profitability, organization, etc., etc. So from that perspective, no, I don't think that the SSM is doing too much. To the contrary, I think the SSM is exactly at the right place. That's to say, not enough to rest on our laurels. That's to say, we have a good system for validating internal models. We have a good system for following some risks, credit risk, market risk, etc. All good, but we can still make progress. And still, we need to address the new threats which are developing short-term, mid-term, and long-term. And for us, it's very, very important, because building resilience means indeed to be able to withstand let's say, the shocks of the daily life. Then resolution enters at the moment when the shocks are so unmanageable that we have to consider that the bank is failing, and then we have to protect the financial stability. But the better the risks are addressed in what we call a going concern mode, the better for the overall resilience, obviously. By the way, by adding this resolution preparedness level to the banks, we also bring an additional level of resilience in the system to be able to tackle potentially unexpected situations. So I think our role today is indeed to continue this monitoring of the risks and monitoring the adaptation of the business models, governance, risk controls of the banks for good days, but also for crisis times. And this is exactly what we are doing together.
And before we started, I was actually having a conversation with someone outside, and this was a person that works in the private sector. And we're talking about regulation, and one of the themes that came up is you can have a very good playbook, but if you look maybe perhaps to the past 10 years since the financial crisis, and this speaks to perhaps the good value of regulation, you haven't had major incidents. You mentioned Banco Popular, but you know, relative to size, that was a small incident compared to other institutions that we saw play out outside of European jurisdictions. Are you confident if that were to happen, you would have the agility and the capacity to translate what looks good on paper into actual real-life implementation? Because I guess many here would have to do the implementation of these rules. Do you trust it looks good on paper, but it's also operationally well?
I guess, I mean, let me maybe answer this question a bit more broadly, and also, I mean, remind everybody of an exercise we're currently doing, and I think Dominic mentioned it. This is the cyber resilience stress test that we're currently doing. So why are we doing this, and why I think it's also in the best interest of the industry to do this, because we will have information that we gather from this exercise that we then also feed back to the industry. So we do this cyber resilience stress test to understand how would we respond, what are all the things we have to do, all the stakeholders, how do they have to communicate, what redundant systems do we need in case a big institution is hit by a cyber attack. So would anybody think that, you know, if a cyber attack hits, that we have then an exact playbook that we can follow, and if we just follow this playbook, everything is fine? So certainly everybody would say we can never exactly plan the next crisis. But I think all we can do in quiet times, and here it says risk readiness and resilience. I think the readiness part is very important, because we don't know where these risks are coming from. We don't know where the cyber attack will hit. But the better we are prepared, the better we will be able to also to deal with this situation. And this is why I know this is burdensome for all of us, all this dry run and these crisis exercises, and I'm sure this is also being done in all the institutions that we have here represented in the rooms. In the room, I know that people sometimes feel like, well, we could do other, you know, day-to-day work, which is more important, but I think we really need to do this preparation, because it's only then that we understand where are the frictions in the system, where's very simply the person that doesn't know whom to call in case of a crisis. So this is why we're doing all this, and I think we are very well prepared, but of course nobody can give you the 100% guarantee that you know how the crisis would play out and what we would do then.
Yeah, indeed, it's at the core of this new strategy. That's to say, we've built the bricks for building this resilience, but we need to be sure that indeed we can use these bricks when and where necessary. So that means that we need to test even more, to implement different tools, asking banks to show us that they are able to find the right data at the right moment, etc., that we are ready ourselves. And here there's a continuum. Banks should be ready for their own crisis. This can be seen as very, very strange, but in reality, this is exactly the story. If we want to implement a successful resolution decision, banks should be ready for their own potential failure. What does it mean? It means that banks should be ready to give us immediately all the elements we need to implement the decision. If we decide to sell the bank to somebody else, or the assets and liabilities to somebody else, we need to build a data room immediately. If we want to implement what we call the bail-in tool, we really need to know the owners, the instruments, where they are, the jurisdiction of a registration, etc., the CSD, etc., etc. So all these things should be in place. The best thing to do is to test that they are in place. So this is is for the banks. For us, single resolution mechanism, we decide in Brussels, but the implementation is for the national resolution authorities. So that means that the national resolution authorities should be ready. That's why we have developed this notion of what we call the handbook, the national handbook in each and every jurisdiction. This handbook should be fit for purpose, that's to say ready to be used tomorrow morning to implement the next decision we could take in case of a failure. We have obviously an MOU between the SSM and the SRM to tackle all the nitty-gritties of a communication at the moment of a crisis. This is tested regularly. You can tell me, okay, all good in Europe, but what are you doing abroad? Because banks are international ones. We are doing exactly the same things. So in April, we have a new round of a stress test with our colleagues from the UK and the US. This is called the trilateral exercise. So we are simulating a crisis, a cross-border one, and we are testing some elements of a framework. Who would take the decision, who would communicate, where the liquidity could come from, etc. And we are gathering the authorities from the European Union, Banking Union, the UK, the US. So just to give you an example of what we are doing, we are preparing ourselves to tackle the potential difficulties. And this will be at the heart of the new strategy to increase even more this level of preparedness and tackling all the difficulties. We will find two elements which were not yet mentioned, and perhaps that's a good occasion to come back to the regulatory framework. By testing all these things, we will find two things. I already know them. One of them is that when we implement resolution, we have also to compare the benefits of resolution compared to national insolvency rules. And here there is no harmonization, neither in Europe nor between the different countries elsewhere around the globe. And there will be a moment when there will be a need to find more harmonization inside Europe at a minimum, and perhaps even more. There is an initiative taken by UNIDROIT working on this one. And the second element is that once we have something entirely ready, entirely tested, we need to look outside of the banking sector, because there are a lot of interconnections between well-regulated, well-prepared institutions and others which are less prepared. And I have in mind, obviously, what we call the non-financial banking institution, the non-banking financial institutions, NBFIs, which are at the heart of some recent events, not March 23, but previously. We've seen that there could be contagion between this less regulated world and our banking world, and I think we need to foster the work for better regulation and better rules for these less regulated institutions.
And we're running out of time, but before I put the final question to you both, I do want to ask a question, go back to Chair Book, because you mentioned this yourself. You said in terms of regulation, there's also the question about the medium-term business model and the long-term view. Some would argue one of the best, or possibly the top line of defense for banks would be to have a solid business model that allows them to have profitability and make money. If you compare them to peers, let's say in the US, you could argue they haven't really gone to the full potential that maybe European banks should have to compete as global players. Is that something that worries you, concerns you? And would you believe, or would you say, if there were less European institutions, if you would see cross-mergers, big European champions, this has been in the debate for years and has not manifested. But if it were to manifest, would that lead to a stronger, more solid financial sector and ultimately make the supervision easier for you? Is that the way that perhaps in the future it could look? Or is it more nuanced?
I mean, first of all, I was a bit hesitant to really compare the US to Europe, because the markets are very different, the traditions of the banking systems are very different, and we also see this within Europe. So we have, the countries, this is why actually the joint country visits are so interesting, because we see that we have, across the different countries, we have very different market structures and various, many specificities of the national market. So that's something we always have to bear in mind. So do we have a vision? Do we as supervisors have a view on, what the structure of the banking sector should be? And the answer is no. I mean, this is really, these are again also business decisions of the individual banks, whether they want to merge, whether they feel that, they have comparative advantages compared to other institutions, and what do they want to do with it. I mean, what we have to make sure is first that regulation and different regulatory supervisory practices won't impede any, cross-border activity. And this is, I think, where the single supervisory mechanism and also the whole system that we've put into place, I mean, we have also oversight over the less significant institutions where this is so important. So I wouldn't buy into the argument that it's because of supervision that there's no cross-border activity or less than what one would maybe expect.
Although they do say that doesn't fully happen because the full framework is not there yet. And then that becomes a regulator story. So it's a circular story, but you say you don't fully believe that.
I don't think you can blame, supervision and the single supervisory mechanism and the rules, because these are the same for all. But as we've said, I mean, we've heard about many things. There's many, many differences across European countries, and that has also an impact on, the market positioning of the different banks. So, but if clearly, and then if there are larger institutions, because you also alluded to size, then of course we need, we have also our tools to deal with the risks that are also imminent in larger financial institutions. That's also something part of the equation.
And now the final question for you both. Well, you're going to be working together clearly very closely now in the future. I wonder, what do you hope comes out of the relationship of your two institutions? And for 2024, if you could just pick maybe one, what's top of your pile of dossiers or issues that you want to focus and say, in 2024, I have to handle a lot of things, but this is top priority for me. What would it be, respectively, for you two?
Well, for me, the answer is fairly simple. For me, the first priority is to launch this famous strategy, first year of the strategy, which is extremely ambitious in reality. So it will be a long-term one, a 5-year one, as we've said, but nevertheless, we need to launch it in all the dimensions. And in particular, the first one, the core business, that's to say, this shift from a planning, building the key and initial elements to testing and to be sure that it works. So that means a lot of changes internally in our relationships with banks, internally with our teams. And this is clearly the goal. My main priority for this year is to be able to implement completely this new approach and starting building this new culture around the lines of this new strategy. So for me, this is priority number one. And my priority number two will be to continue developing very good and strong relationships with the SSM on a daily basis. It's already the case, but let's even continue deepening them.
No, I very much agree. I mean, it says it all: readiness and resilience. So, I mean, this is really it's hard to pick this thing, the one deliverable or the one item that's particularly important. But I mean, this is what we're working on jointly in a very good spirit.
Something, a pool of risks, something that you say, this is where the attention is at. There isn't a concentration anywhere for you as it stands.
Well, no, because we have many, we work together actually on all levels. So we haven't actually mentioned there's also a lot of swap programs and all that. So our teams work together very well, but we have to be very alert to the environment around us. So it's less of what we think is important, but what the environment is demanding from us.
Well, thank you very much to the both of you, and you've been very kind with your time. So thank you for this, and we look forward to the rest of the conference. Thank you very much.
Thank you very much.
Thank you very much to Claudia, Dominique, and Maria for such an interesting conversation. Let's now take a deeper dive into the topics of the conference today. And here we'd be very happy to hear from you. You will be able to see the Slido details on stage. Please send your comments and questions to that. And for those of you here with us in the Egg, we will have some microphones in the audience. So now I'm delighted to welcome to the stage our panelists for this roundtable discussion. Sean Berrigan, Director General for Financial Stability, Financial Services and Capital Markets Union from the European Commission. Manuel Preto, Deputy CDO of Santander Tota. Birgit Rodolph, Chief Executive Director of Resolution and Prevention of Money Laundering at BaFin, Anneli Tuominen, Member of the Supervisory Board of the European Central Bank, and replacing Jérôme Grivet a bit at the last minute, so thank you to him, Axel Marmoton, Head of Capital and Resolution. And our moderator is Joe Lynham, Business Editor with News Talk Radio. Unfortunately, Irena Tagnagli has sent her apologies, she can't make it. Now over to you, Joe, and the panel, please.
Thank you very much. Thank you, Susan. Thank you. Change. Good morning to you all. Good morning to you. I hope you're all well. Interesting so far. This egg building reminds me a little bit of University College Dublin when I was doing my Bachelor of Commerce. Did you go to that university, Sean? Did you go to UCD? I did. You did. So there we have two. Does it remind you of a bit of Theatre L, Theatre P? Yes, it does. Yeah, the seats are more comfortable here. So anyway, thank you for giving up Carnival to be with us today. I'm dressed as Donald Trump for my Carnival cast. So good, so good. Anyway, the SRB is a bit like a referee in a football game. If he or she is doing his job, you shouldn't notice him. But of course, if someone kicks someone in the face, you should get a red card pretty quickly, and the match should go on. Today, we're going to talk about the 3 R's of risk, readiness, and resilience. And as Susan has already said, it's on the record. There are a few of my journalistic colleagues in the audience, and some are watching online, of course. And if you do wish to comment, there was a Slido QR code. Maybe you could, yeah, there we go. If you could put that back up. If you do wish to comment, and I'll get the questions and I will put them to the panel over the next hour or so. Or if you're feeling extra brave, raise your hand. Put your hand up, and we have roving microphones, I think, and we will put them to the audience as well. I think you've already seen in the website the bios of our illustrious panel. Sean Berrigan to my left. Alex, thank you very much for stepping in at the last moment. Thank you very much. So can I say that...
By the way, it's Axel.
So should I give you underarm questions, easygoing questions, because you've joined us at the last moment. Birgit Rodolph, thank you very much for joining us from I love this, Bundesanstalt für Finanzdienstleistungsaufsicht, thankfully BaFin for short. Thankfully. And Anneli Tuominen. I don't know what that is in Finnish, but you're definitely a member of the Supervisory Board of the European Central Bank, and thank you very much for joining us as well. Hey, hey. Should I say Kitos? Kitos. And Manuel Preto, the Deputy Chief Executive from Santander Tota. Obrigado. Now, I'm going to start with the lessons from the mini-banking crisis in March last year. We don't even have a full year behind us. I might ask you, Anneli, to start. What did we learn from the meltdown of 3 or 4 regional banks in the US, followed by the swallowing up of a giant Swiss bank by another giant Swiss bank?
Right. Thank you so much. Thank you for the invitation to be here, first of all. The lessons learned, maybe I would like to touch upon the banking side and the supervisory side, because there were not that many regulatory issues. Well, the banking side, I think the main thing was really the lack of good governance, the lack of good risk management. And that applied to banks here on the European side and on the US side. And that's really a key, to have a good board which has both, of course, it needs to be able to speak to the management, but it needs also to be able to challenge the management. Otherwise, it doesn't function. And then there were many failures in the risk management culture, also from the point of view that, like the banks in the US, they were more interested in short-term profits as compared to good risk management, which became a failure. And they didn't really take into account the impact of the increased interest rates, the higher interest rates, and what would that mean from the bank's point of view. And of course, they were concentrating a lot their both on the asset side and the liability side, and then what happened when the interest rates were high and when the rumors started to flow in the social media. Investors were looking at the market value of the bank and then withdrew their money. The one question, of course, that we supervisors would need to look into, and I understand there's also work ongoing at the FSB, is regarding this social media, the very fast move of information, which means that you can withdraw your deposits very quickly. So what can we do? What are the really ways to improve? We can, of course, we can ask the banks to be able to have money available for 5 days, or we can change a bit the liquidity rules. But these things happen so quickly that it really needs to be assessed very carefully. If I may continue, just a couple of points from the supervisory side, is that we supervisors, we would need to be able to move, even though we sometimes see that the capital adequacy level is high enough, there's enough liquidity, but the business model is rotten. Mm-hmm. So we would need to be able to interfere. We would need to be able to act and not just to be delayed with our actions. And that also happened both on the other side of the Atlantic and here in Europe. What the supervisors also need to assess very carefully is that all the board members are fit and proper, that they know what they are doing. I think those are really the very main things. And then maybe one thing more, that we would need to have more visibility. What would be the impact of bail-in in the world of investors, and how could we actually operationalize bail-in activities? But those are really the main points from my point of view. Thank you.
Can I ask the same question of Birgit Rodolf from BaFin? Were you surprised? Let's focus on the Credit Suisse thing first. Were you surprised at how the Swiss National Bank handled it?
I would actually, if you don't mind, I would like to comment on both sides of the ocean.
Yep.
Closer, because if I go one step back, I mean, what did we really see last year? We saw banks which had weaknesses in risk management, in governance, and in business models, as Annelie just pointed out. Unfortunately, none of those issues are really new in the banking world. And then if you go one step deeper, for example, let's take SVB. Yeah? SVB was a bank which hasn't even had a chief risk manager for quite some time. Yeah?
Yeah.
So this is, for me, not something which usually should not happen. Yeah? Then they were financing long-term investments with short-term funding. The funding were coming to a super large portion from the venture capital industry. Mm-hmm. Those depositors had super big amounts of deposits, of course uninsured deposits, because we have this 100,000 euro limit in Europe. In America, somewhat similar. So this high concentration of funds from a very limited number of depositors. In this little group, basically, I mean, bad news spread quite fast. you don't even need social media for this. Social media is enhancing it, but you can also use just your mobile phone, because basically the people know each other, and other banks knew the group of investors in SVB. So what happened, of course, was the bank run started. The bank had to sell securities under par, realizing losses. Rumors spread even more, and a vicious circle started, and that basically caused the end of the bank. Yeah? Lessons learned from this case, as Annelie pointed out before, on the supervisory side, there really wasn't enough liquidity for SVB. The business model was questionable, to say. And on the resolution side, SVB was growing so fast that the bank just started to prepare itself for a resolution. So there were no dedicated amounts reserved for loss absorption capacity. There was zero. Yeah? Mm-hmm. So if we now come back to your question, actually, which is Credit Suisse. Credit Suisse is in a way similar but also different. Credit Suisse had deficiencies in the business model and also on governance over years. And the industry knew this, and the regulators also knew this. But Credit Suisse had been prepared for resolution for quite some time, and there were TLAC reserves for loss absorption capital were built up, and this could have been the first resolution of a GSIB worldwide, actually. You know? And it wasn't. It was a merger solution. Let's call it a merger solution, but nevertheless. That the preparation for resolution has been done, and that the loss absorption capital has been built up, that facilitated clearly the merger as well. And yeah, that is my point of view.
Were you surprised at the AT1 issue within Credit Suisse?
I think Dominic made a very clear statement on this, and there's nothing to add.
But that's
yes.
You were watching in Frankfurt. Were you saying OMG?
No, for me, I mean, we would have started with the equity.
Yeah.
So, I mean, there's a waterfall on the.
Sean Berrigan from DG FISMA. Were you surprised watching, a mile up the road?
I mean, was I surprised by the event? Yes. Was I happy it was solved? Yes. Did I expect it to be solved exactly as it was? Probably not. But I think we have to be realistic here that, I mean, all in all, we were all very happy on the weekend later that something had been done.
Yeah.
And I think all of us need to be a little bit humble that when we're facing those kind of crises, those of us who've sat around tables, and some of us have sat around tables, the most important thing is to get through and to follow the rules as closely as possible, but of course it's not always possible. So of course they didn't do it exactly as the way we expected, but as I said, the most important thing was to get through. Now from a resolution point of view, what interested me was, however, that even though CMDI had predated any of this, some of the issues that arose, particularly in the United States, although in a very different context, were similar to the ones we were trying to address here in the EU. Mm. So in particular, what happened around the US banks and deposits was deposits began to move and move very quickly. Now, those deposits could have been bailed in. Could have been, but they were not. And they were not for two reasons. One, the risk of contagion to other parts of the sector. And secondly, the risk of economic damage to the local economy. And what surprised me was that those were very similar arguments to which underlay the work we did on the CMDI, because it was this very similar story of mid-sized banks which do not have sufficient bail-inable material, as Dominique mentioned earlier, and they therefore are left to bail in deposits, very often are not able to bail in those deposits for those two reasons as well: contagion risk and economic damage. And that means they turn to the state, as was the case in the US. They turn to the state. According to the principles of the BRRD, we are not to turn to the state. We must minimize the risk to the taxpayer. So we have to find a way of ensuring that when that situation arises, we have a mechanism in place that can deliver funding and avoid a stability risk, but also avoid that the taxpayer pays. And that's essentially what the CMDI reform was about. So it was interesting for me, surprising in a way, to find that some of the issues that we had spotted in our sort of smaller to mid-sized banks arose also in what the US calls smaller to mid-sized banks, but in our world are pretty big banks.
Yeah. Did you, by any, just out of curiosity, did you get a call from anybody in Switzerland during the Credit Suisse? Because you have a bit of experience, LaShawn, and you can share your experience now with banks not working out.
Did I get a call? I did get a call. I won't tell you when I got the call, but I got a call, yes.
Okay. Just share with the 200 people here and the thousands watching online, because you have a lot of experience. What was the tenor of the call?
If I tell you that, you know when they called.
Oh, what? Right.
No, I think there was a sense of, I think there was a mixture of a stress and relief, I suppose. I mean, that's basically it. I mean, I think they had got it done, but it had been a pretty stressful occasion, as you would imagine. As has been said by Birgit, this was the first ever GSIB managed in a crisis. Now, I think, let's be honest, there were two things which surprised us about this. The AT1, which others have already mentioned. And what was interesting about that was to show that although our exposure was not so direct to Credit Suisse in the EU, there was an indirect exposure which was not spotted. And that came through markets we share. So there was a focus on direct exposures, that's where you look, but actually in a GSIB's kind of global public good. You know, we're all connected to a GSIB. And this was an indirect connection.
Through bond ownership, or what was the indirect exposure?
Through bond ownership. Yeah. As it turned out, through ownership of similar but not exactly the same bonds. But they were both called AT1s. So that was a risk of market contagion. And the statement that was issued, I think, sorted that. I had a second point there, which I've completely forgotten now, but it may come back to me. But I think the overall feeling I had was that I was just glad it had been sorted on both sides, and that we were able to have a lessons learned afterwards, where we could identify where things could have been improved. But of course, if it hadn't been solved, we would have had a very different lessons learned, a much less relaxed one than we're having now.
Okay, easy first question from Alex Marmonton, who has just stepped in with Crédit Agricole. Did you own any Credit Suisse bonds?
No. Again, it's Axel, not Alex. I'm sorry.
Oh, sorry, Axel. Sorry, my mistake.
Yes, on the crisis, banking crisis last year, the first remark I wanted to make is that there has been no real crisis. There's been some banks who had problems, situations. When mentioned the American banks, SVB, First Republic, etc., and the Credit Suisse situation. And these were situations that came from bad management, principally. And so this wasn't a crisis. And if I was to quote Supertramp, who did a wonderful album whose name is Crisis, What Crisis? Yes. There has been no real crisis. It was just individual situations that were to be managed and were managed efficiently by the regulators. So this is one of the lessons, is that there was a good level of reaction of the authorities. And these situations are not quite comparable from the one side of the Atlantic to the other, because concerning the American situation, there was clearly bad management, but also probably bad regulation, lack of regulation, which is in Europe is not strictly the same, because we have a regulation system which is really really stronger than there. And the Swiss case, mentioning the 81 of Credit Suisse, is probably a specificity of the Swiss world, and not comparable to what would happen in Europe. And in that regard, I have to salute the initiative by the authorities in Europe to communicate very early after the Credit Suisse had this 81 problem to reinsure the markets. And this is nice. It's the need for very, very rapid communication in this crisis, indeed.
Yeah, let me bring in Manuel Preto, the Deputy Chief Executive with Santander Tota in Portugal. How important is speed? In other words, is 48 hours too slow to react?
I think it's a very short time frame. We've been on the acquiring side of assets from resolutions over the past decade twice. Banif in 2015 in Portugal, and then Popular in Spain and Portugal in 2017. And in the case of Popular, it wasn't even a weekend. It has to be done during the week, overnight. I think that the key here is not only what you have planned for a potential resolution, but then how you can sort it out during the very short time frame that you have. You're running essentially against the clock, because you know that if a bank reached the need for resolution, then something really bad happens, no matter why it did happen, but you're confronted with the need to decide and close some sort of resolution very, very quickly. And for that, the first thing clearly is information. Even with a great playbook that you might have prepared with all the possible scenarios and with the kind of resolution strategy that you might undertake, something happened, I'm sure, over the hours, days, weeks prior to the resolution that has changed the balance sheet, the assets that you have to deal with. So having timely information and a correct assessment of what is on the table is of a very, very critical nature. Because if you aren't able to, as a resolution authority, of having that information and convey to the interested parties in any sort of acquisition that the confidence that the information you're providing is as accurate as possible, it's very difficult then for anyone to be interested and to be available and able to put a price for the assets, to put an offer in, and for the whole process to take place. So, I think there are two stages here. One, which is timing is very short, so you need to have not only a playbook ready, but proper information to be able to push any sort of transaction through. And then the whole communication about what is going to happen, because these are typically banks which have lost confidence of the market, have lost confidence of investors, have lost confidence of depositors, and anyone who buys the assets has overnight to be willing and able to take an underperforming asset and stem whatever sort of liquidity drain that is existing, because typically you enter a resolution for because of liquidity and not because of capital. So you need to be able to stop that drain and to be able to pick up even some of the lost liquidity very, very quickly. So if you're not able to do these two things, it's very, very difficult to undertake a successful resolution. And this, of course, as you said, in a very, very short time frame, in which, of course, knowing that everyone is running against the clock, the stress keeps increasing, because you know that there's a deadline at which either you're able to do it as you had planned, or then you better have a very aggressive plan B to take care of the matter.
Annalie from the ECB, despite the presence of the SRB and the SRM, there was still a lot of speculation online about Eurozone banks. Some of them two or three were being named very publicly on social media. Did that worry you?
As Claudia was saying earlier on, the banking sector is very resilient in the Eurozone. And one figure that we can remember when we started 10 years ago, I think the figure on NPLs was more than 1 trillion, and now it's some above 300 billion euros. Anyway, of course, one needs to be always vigilant. One needs to look at the risks of various banks. But regarding your question, personally, I'm a bit concerned about the amount of misinformation and disinformation we have in the social media, and also sometimes to the media as well. And so far, I'm not aware of any events attacking the financial sector, but as we know, there are some, say, governmental actors who are very active in hybrid warfare, and of course that includes hybrid influencing. So we really should be prepared, and the banks should be prepared what to do if suddenly in the social media in different parts of the, say, Europe, in different countries, suddenly, simultaneously, there's this negative false information about a bank. So the banks would really need to have its communication ready to come out and to give very exact information about its status. In such a situation, on the other hand, it would be a bit risky if the supervisor was to start to comment anything about an individual bank, because we know that the moment supervisors open their mouths, so then the investors start to doubt that something is wrong. But it's really, I would look at the banks, and they would really need to follow their what is written about them in the social media. And in some instances, we have asked our banks to actually assess the social media better than earlier on, because it's a risk that needs to be taken seriously. And of course, in the US case, some of what was happening there, the information was more or less correct, but now I'm really talking about incidents where the information is misleading, where it's disinformation. And I think this topic was also discussed in the World Economic Forum, where the disinformation is one of the major risks of tomorrow.
Birgit Rodolph from BaFin. Germany has plenty of regional banks. Did the crisis, or the mini crisis from last year, did that lead to an investigation to see if they were fully capitalized and had the right boards and the right governance to deal with any issues with the regional smaller banks in Germany?
I mean, I'm not on the prudential side of, within BaFin. I'm responsible for resolution and money laundering prevention, actually, and the non-allowed business. The prudential side, of course, is behind our large amount of banks in Germany. We, from the resolution side, have a different point of view. We look at banks and figure out which are relevant for systemic relevant. I mean, this is a key question. Are they systemic relevant? Yeah? And for example, coming back to the Swiss question, that the Swiss solution did what it was needed. It has calmed down the markets. Yeah? Maybe not the European solution with the AT1, but it did fulfill the necessary measures. In Germany, most banks are not systemic relevant, you know? As in other countries as well, which have many banks. So you have to pick the ones, and you have to see where can a domino effect might happen, yeah? And we look at these scenarios quite intense, of course, yeah? That's our job. Yeah? But I would like to, if I may, I would like to come back to one topic on the data, which you mentioned, because I think this is a very important fact. We have done together with the SRB in the last 4 years about 40 bail-in dry runs with banks, and several dry runs with the same banks over years. Yeah? And though the banks had to deliver the required data within 24 hours. And what we have seen is that it takes time to get to this level, and to get to the right level of data required in the right quality. We all know that banks have also sometimes issues with their IT systems, and it's not just you push a button and you have the data. It's not like this, especially not with big banks, and we're talking here about big banks. On top of these 40 bail-in dry runs, we did 9 fully fledged bail-in dry runs. And what does it mean is we work together, the authorities work together with the institutions. So we start with the data delivery after 24 hours, but then we start really to do the calculation on the bail-in tool. What are the impacts on accounting? Yeah? What are the impacts on regulatory and on tax? Yeah? What are the impacts on the business model, because this might change? Yeah? And what does it mean to this bank? Yeah? And then in the last step, you prepare the external execution of the bail-in. Yeah? That doesn't even sound easy, and it's definitely not easy to do all these things in a very, very short time frame. It's a kind of very important preparation. And what we learn from all these exercises with the banks are that progress happens gradually over time. And performance, and that's a very interesting point, can fluctuate. So a bank which is good this year might not be as good next year, though that can change, because the business model may be changed. And each bank is unique. And also, they do not advance in the same time other banks have advanced before. So it's like, that's why you can have playbooks, etc., but it's always individual. It's an individual business which we are in, which also makes it so interesting.
Okay, before we move on to the banking union, could you put up the Slido QR code, please, one more time? Because we got a question in. Yeah, there you go. We got a question in from a Mr. Anonymous, and his question is: could the Credit Suisse merger have been done without the post-Great Financial Crisis (GFC) reforms? Sean Berrigan.
Probably not, in fact. I mean, yes, it could have been done, but it might have been done differently. I mean, what they did, interesting enough, in this merger was they followed a large part of the resolution framework we had, but just not fully. So they had prepared, they followed a lot of the decision-making processes that were there, but in the end they opted not to go for the resolution option, which would have resulted, of course, in a different allocation of losses. They went for a merger option, which resulted in the chosen allocation of losses that they wanted. But I think without that resolution framework in place, it would have been a much more difficult process. I mean, if I think back to 2010 in Ireland, when we were there, where we had no legal framework, we were facing many of the same issues they faced now. The Irish banks were not GSIBs, but we faced many of the same issues about how you treated bondholders in a hierarchy where they were at that time.
And of course the Irish government had provided a 100% guarantee.
At that time. Yes, but I mean, even so, I mean, legally speaking, the senior bondholder was equivalent to the deposit holder. So there was a lot of discussion around bail-in in those days, but it was legally impossible.
Yeah.
So I think we have to hope something would have been done to solve it. But I think it was much easier for them with the resolution framework, even though they did not carry it through to its final point.
Okay, keep the microphone there now. We're going to move to banking union. Are you disappointed at the pace at which banking union has been implemented?
Yes.
Okay, next question. Tell us more.
Well, we've been doing it for quite a while, let's face it. And the story of banking union, of course, is that there was a crisis. There was a huge need to take steps to restore trust in the system. And so big steps were taken under the influence of the crisis. It's the usual story. So at the early part of the crisis, when the pressure is on, big decisions are taken. And let's face it, very big decisions were taken in many fields. You can think of the ESM and all of these things. But in this particular field, you had the creation of a single supervisor, something which, by the way, the member states before the crisis said was totally unnecessary and impossible. But it was then done within a year and up and running within 2 or 3 years. Then we put together the Single Resolution Board. Again, something which I guess before the crisis we would have been told was impossible or unnecessary. So these were, I remember I used to speak in those days that in EU time, this was the speed of light. Okay, we were moving. To do such a thing in 2-3 years was just unimaginable. I think, though, as the crisis has kind of faded away into memory, the pressure has eased off.
Are we moving at the speed of sound now, or even slower than that?
Are we moving?
Are we moving? Okay. Glacial.
We are moving, but we're moving pretty slowly.
Okay.
You have to be up close to see it.
That's glacial.
But I think we shouldn't underestimate what we have achieved, though. I mean, these two institutions are, in my opinion, the bedrock for the future, integrated banking system of the Union.
Yeah.
If we don't have these institutions, there will not be an integrated banking system. We're not there yet, but they're a fundamental part of it.
Manuel Preto from Santander Tota in Portugal. Would you like to offer mortgages in Ireland or Estonia? Or other countries? I just named 2.
Listen, I think that the model that we have that's specific to Santander is that we have units in several countries we operate. So the cross-border business that we do typically is linked to the companies and the individuals from the country where we are based, and typically with retail banks which have a significant market share in these countries. So it's clearly not something that is or has ever been on our mindset. But I perfectly understand, the level still of barriers for cross-border business in banking in Europe is still significant. And that's very, very clear.
That's because regulators want to keep a tight control about lending, don't they?
I think it has to do with several things. I think it has to do with that. I think it has to do with the fact that you're still dealing with different countries, and different countries with different cultures, different ways of doing business, different laws that apply from it's not just the fact that a bank can or cannot operate in each country, but even the way products are set up in each country is different. So you start going into the fine detail of what is the banking market, and it is very different from country to country. That doesn't mean that you can't have businesses and products that you might sell or commercialize across several countries. But there are still very big chunks of the banking business which is still very local.
Axel, can I bring you in? I don't know whether Crédit Agricole is in Ireland or in Estonia, but would you like to sell financial services? And isn't the problem that your regulator will say you won't be able to get your hand on the asset if someone doesn't repay that mortgage?
I don't think I catch the question. Could you rephrase it, please?
The lending of mortgages across borders, isn't the problem that you cannot necessarily or legally get your hand on the house, in this case, or the asset, if something goes wrong? Otherwise, there would be cross-border lending.
Well, I think I won't be entitled to answer that question. I'm sorry, because I replaced Mr. Grivet in the last minute, so I have to...
We can pass it on to Annalie. Isn't that the problem? Not being able to get your hands on the asset. That's why cross-border mortgage lending is just not possible at the moment.
Cross-border mortgage lending is pretty limited, as we know. Also, I think it's from the point of view that banks also operating in their home markets know the markets better. When it comes to getting hold of the assets, I must say that personally I'm not that familiar with the problem. I wouldn't imagine it's not impossible either, but that is something that one would need to look into. But when you were discussing this earlier on about the banking union, so I think that time should little by little be ripe for having this full banking union with the EDs. I understand that at the beginning some member countries were a bit hesitant because they thought or they understood that the banking supervisory standards were not similar in various countries, and in some countries the banks were not in such a good shape. But now, as we are approaching our 10th anniversary at the SSM, so I think that it's really prime time to start to change the views and to understand that only through the banking union we can reach a truly integrated banking market in Europe.
Birgit, you shook your head when I suggested that you wouldn't be able to get your hands on the asset.
Yeah, I think it depends on the country. So there's cross-border mortgage business in Europe. I know a couple of banks doing this. You have to have first you have to have a distribution network in the country you want to do these kind of, if you talk about residential business, you have to get access to residential creditors asking for mortgages. Yeah? I think that is the main problem, that this kind of distribution is not there. But and yeah, in some countries there might be legal issues, but this is not a key issue from my point of view. Yeah?
Okay, well, what about the fact that in Malta, they pay, the average mortgage for new mortgages is 1.89%, and it is 6.2% in Latvia in the Eurozone. That is such a divergence. It means that people in Latvia will say, I want to go to a Maltese bank, but that's not possible.
I think we are back to business models and risk you want to take on your business model, and which countries you want to do which kind of business. Yeah?
Sean Berrigan, you wanted to get in on that.
No, I just wanted to come back on this collateral, access to collateral. I mean, there are, I'm aware at least, significant differences around Europe between the time in which you could access collateral. Many of those have been narrowed now. There were some member states we will not mention where it took a very long time to access collateral, but we don't mention them now. But the bigger issue I always found in terms of cross-border provision of mortgages, i.e. not establishing but selling it from one country to another,
that's what I mean,
is due diligence and due diligence costs. You almost need to have the distribution network in the country. It's just too costly to do it. So this is why they don't do it on a cross-border basis. They can do other services on a cross-border basis. And as for why interest rates differ from one country to another, well, this can also relate to the local conditions for capital as well.
And can that not be streamlined and unified?
No, because it depends on the risk. And here I'm getting into areas I shouldn't. I see Claudia. I'm peeking my eyes definitely on Claudia, so I don't make any mistakes here.
She's still smiling. That's okay.
She's still smiling. So it's okay. It's to do with the risk profile of the banks concerned, how much capital they hold, and that's based on a whole range of things which I'm not going to get into, but that varies from one country to another.
Okay. I'm going to move on now to other topics. I'm going to talk about climate change because it was referred to a little bit earlier, and the impact that climate change might have for banks and for the wider economy. Manuel or Axel? I know, Axel, could you take a question on climate change?
I can. Please answer. Take a question.
Well, just what preparation is a bank as large as Crédit Agricole doing for climate change, for the fact that there will be more flooding events, more fire events, potentially earthquakes, who knows? Mass migration, that's all part of climate change.
Well, I'll give a general answer on that. I think the climate change is clearly a risk we include in our risk framework assessment. So it's important to have this in our framework to identify these long-term risks. And also we have upcoming regulations on that subject that will reinforce the system and the way we apprehend the climate risk in our portfolios and in our activities. So this is important for the European system, the banking system, and we will, of course, apply these regulations like everyone. So that's for now the answer I could give concerning Crédit Agricole.
Okay. Manuel from Santander. Here's a hypothetical. Should banks refuse to lend to people wishing to buy an old, drafty, cold, poorly insulated house?
I think banks need to be sure that the money that they lend, the prospects of it being paid back is quite high. You know, I think we can't never forget that where the money comes from that banks are lending. You know, it comes from depositors which have trusted banks, and that's the main source of funding for European banks, depositors that have trusted banks with their savings. So the risk management on the part of banks has always to come back to, you know, am I lending to someone in which the prospect of being paid back on time and smoothly is significant? I think that is the main issue. Then you can get into whether or not banks and how can banks help green transition and financing the huge amount of money which will be needed over the next years and decades to do that. And I think that is where banks, I think, are starting now. And I think it has to do with a whole range of things, from being able in their IT systems to be able to have the information to differentiate between the kind of lending that they are providing and what in terms of the impact on climate. Secondly, being able to, in terms of the portfolio that they already have, to differentiate in what will be long-term lending or what in the future will need to be diverted to other sectors, just because society will divert its investments elsewhere. And then even on the product basis, you know, can we help in terms of having more attractive product propositions to things which help out in terms of climate change? That's a different area. But, you know, going back to your question, I think that we can never forget, you know, what are we entrusted with, which is depositors' money, and that is the safeguard above all that we need to guarantee.
Okay, Annalie, I've got a question came in from Slido, also didn't give their name. A lot of shy people out there. Do we need another EU or Eurozone crisis in the banking sector to complete EDIS, Deposit Insurance Scheme?
I do hope not. Of course, I mean, what has happened in the past, we know that when we have a decent crisis, it helps to make changes, but I wouldn't be that pessimistic, because as I said already, that soon we have had 10 years of the SSM supervision, and the banking sector is now much more resilient than it used to be. So we would need to also understand what are the benefits of the EDIS and banking union. I know that it's not that easy. There are some members who are not that, say, positive, but I personally am positive that it wouldn't take that long. I hope I'm right. Most likely John knows more than I do, but I do hope that we do not need to go through another crisis.
Okay, Sean Berrigan, same question. You spoke before very eloquently about how much the speed of light in terms of change in the aftermath of a crisis and how we're now at crawling pace. Maybe we need another crisis.
I think I've been asked this question before in this actual forum, maybe last year or the year before. So
Déjà vu.
I better make sure I give the same answer. I really don't like this discussion about crisis as a means to make progress. And I've said it before and I'll say it again. It is the most inefficient way to make progress, that you take a huge hit and all this damage and then you make the steps you should have taken before. So banking union in itself so far is a good example of that. Before the crisis, we had an integrated banking system, but no architecture for banking union. After the crisis, we have the architecture for banking union, but we don't have the integrated market anymore. The hit was the integrated market. So I don't know whether it's true or not, maybe it is, but I hope it's not, because it's an extremely inefficient way to make policies. We should, put in place the things we need before the crisis happens, rather than after the crisis happens. I don't think it is necessary, though. I think the interesting thing about the CMDI discussion is that it is revealing that although the CMDI proposal, in my opinion, and I would say this is brilliant, I'm looking at one of my staff members out there who's responsible for it, it's a brilliant piece of work, there's still a hole in it. And that hole is what we do if national DGSs are not enough to cover the costs. Now, we have filled that hole by a specific bridge, which those of you who know it will know, a bridge to the Single Resolution Fund. But for me, this is not the optimal approach. The optimal approach would be to have a European Deposit Insurance Scheme available to fill that gap, so that if the national deposit guarantee scheme is not adequate to meet the requirements, EDIS would step in and not the state. So I think even in discussing CMDI, those who have issues around EDIS are beginning to see more clearly how it fits into the system and how it meets these two basic principles of the EU resolution framework and the global resolution framework, which is that you must preserve financial stability as the primary goal, and then you must do it in a way that minimizes or minimizes the risk that taxpayers have to pay.
Manuel, do you want to get in on that, on CMDI? You probably don't want to speak about that.
Sure.
Yeah.
See, I think that we're clearly supportive that the resolution framework be expanded beyond the largest banks. I think that there are pros and cons to when bringing on board the smaller banks, how you use the funds which were created with different contribution methodologies, and that has to be addressed or should be addressed. And of course, that I agree that without a public liquidity backstop, whatever it is, it's very difficult then to have these resolutions to operate, because again, you come back to what we were discussing in the beginning of this talk, which is when banks typically fail at the speed that they fail, it's because of liquidity issues. Typically, that is the trigger, irrespective of which problem surfaced beforehand, whether it was a business model problem, a capital problem, whatever. But the trigger for the resolution and for the need for a resolution typically is liquidity. So unless that is well sorted out, then there's always going to be a problem in implementation.
Okay, Birgit, can I bring you in? Do you want to comment on the CMDI, or shall I put a different question?
What a question is this?
Well, it's in relation to climate change. I can give you the question. We've just got a question from Slido. I can put it.
Actually, I take a couple of or maybe I try to give some comments to CMDI and those issues around. Let me come back to what I said at the beginning about SVB and about those investors from the venture capital. I picked this example not without a reason. Yeah? I'm convinced that depositors are not all at the same vulnerable. There are differences in depositors. I personally make a difference as a private person or an institution. Or an institutional investor where I just expect a higher knowledge, higher financial knowledge, and knowing in what kind of papers I'm investing money. So I think we don't need the same level of protection for all kinds of investors. I think we need a strong and credible deposit guarantee scheme. But I also think if we, and that is actually what the CMDI is also asking us, do we really want a higher coverage for everyone? If the answer is yes, yeah, then we have to be honest and transparent that that means that to the banks, higher bank levies to finance this coverage. So someone has to finance this. Yeah? And this will not be, there's no free lunch basically. Yeah? You can do this, you can ask for this is fine, but who's going to pay for it? Yeah? And that, I think we have to be honest. Yeah? So I don't mind that we increase the amount of banks where we focus on a potential resolution and plan for the resolution a little bit. That is fine. We see this especially with these mid-sized banks, where it's sometimes hard to define: could cause this bank a failure of this bank a domino effect, yes or no? And if you have a question, then in this case you say better safe than sorry. Yeah? So you better add one bank more than one bank less. I think we're all on the same page of this. But I disagree to make the access to the SRF funds or the DGF funds easier. You know? I think, and we have said this before, resolution must foremost be financed by the equity holders. We talked about the Swiss case, and the creditors of the failing institution. That is strong opinion of myself, and therefore I think it's very important that we have built strong MREL resources and build up subordinated MREL resources. And we saw this again in the Swiss case. Yes, it was not a resolution, but it could have been a resolution. And the subordinated TLAC money was in place. It wasn't used, yeah, but it was partially used for the merger. So,
yeah. Birgit said there's no such thing as a free lunch. That is not true today. There is a free lunch, and it's coming up very shortly. Now, I want to see if anyone in the audience has any questions. And remember, as they say in Scotland, shy bairns get nae sweets. So, if you've got a question, put up your hand, maybe give us your name, rank. Oh, we've got a question here in the lady, blonde hair, got a question. We have a microphone making its way to you. If you tell us, ma'am, who you are, who you work for, and then your question, and if you want someone specific to answer it.
First of all, I probably say that I'm really proud and thankful for having opportunity being here. And I must say I'm brave because I'm coming from country which we faced and focus on crisis almost on daily basis. I came from Bosnia and Herzegovina. My name is Neda. And I'm not from banking sector. I'm a stakeholder. And I'm taking some steps by me alone and other to make some changes in my country. Unfortunately, it's a heavy job. And this is something like a question for all of you, maybe for Dominic and Miss Claudia also, because what I'm really wanted to know, you know where I am. I'm not in European Union. And what we have in Bosnia and Herzegovina is almost jungle. Why I'm saying that? Because we have some influence of European Bank. We have some project that we can participate in, but still we don't have enough communication with Eurobank and any other sector. So if is any possibility to people from Bosnia and Herzegovina, an institution, not with government, but independently, do some changes in conversation, in communication, by your guidelines or something, to make some changes. Thank you.
Thank you. That's Ada from Bosnia. I presume that applies to all nations outside the Eurozone. Sean, any thoughts? You may not have a thought. I can pass it on if you're stage fright.
I rarely suffer stage fright, but I have to think about the question. I mean, I think Bosnia and other countries are now on the road to, ultimately on the road to accession. That's a process, it's a two-way process where the future member state has to prepare, and we have to help it to prepare to align with our framework. Actually, I've had conversations with other countries, not yours, where I have to make this clear: this is not an exam. This is not something where the union sets out an exam and the member state has to sort of pass the exam to get in. What's actually going on here is that we want to use our framework to prepare the member state, the future member state, so that it can survive, not just survive, but prosper inside the union. So this process you're talking about will now start more and more, where I don't know whether we will be discussing directly with the people in the country, but certainly with the authorities, we will start a process where we will use our framework to help Bosnia to develop, to prepare itself for future entry, so that when it enters, it's not just, as I said, it not just survives, but it prospers in the union. So I think that process is coming, actually.
Thank you.
It's a positive outlook. Now, we're running short on time, so I'm going to move along. Annalie, can I ask you about cyber threats? Dominique Labourex was talking about cyber posing new types of risks. Are you seeing that as well?
I couldn't agree more. Of course, they are not new types as such. I mean, we have had cyber attacks for, well, centuries. But anyway, they are now more frequent and more fatal. Fortunately, we haven't had any fatal attacks towards the European financial industry as yet, but we need to be prepared. We have an increasing number of DDoS attacks, but we have also this ransomware where you really are blackmailing money, and they are getting also more frequent. Unfortunately, then in this sector, we have those, as I already mentioned, about these governmental attackers who have all the resources, who are very sophisticated, and who just have the capacity to hack or attack different sectors of society. The banking sector is maybe one of the most resilient in this when it comes to cyber, but of course banking sector is also dependent on other sectors which are less resilient, like electricity and telecommunications, and also third-party service providers, which do not have that kind of resilience. Of course, DORA will help a bit, but really each bank needs to be more prepared. That's why we are, at the moment, as Claudia was saying, we are having this cyber stress test. We are really looking at how the banks would respond and recover, and some banks really need to have a sort of IT recovery tests in order to see in what kind of shape they are. And I think this is one of the exercises. I mean, banks do not like all the exercises that we carry out. I wonder why. But I think that this is one of the exercises that banks should really also take all the benefit out of it, because if there are weaknesses, so they should also need to become aware and correct, those weaknesses, because this is something that we need to do, and it's a must. I mean, there's no option, it's a must.
Okay. Birgit, do you want to get in there on cyber threats?
It's a must,
okay.
as Annalie said. Yeah.
Axel, Dominique said he won't be coming for you to the banks looking for money this year. You must be very pleased about that. When you get a call from the SRB, do you say to yourself, oh, what do they want now?
Of course not. We're really delighted to have our colleagues from the IRT. And we have day-to-day relationships which are really good, I have to say. So I have to insist on the fact that we are really keen on working with the SRB. And talking about operational readiness, I think it was one of the topics of the roundtable. We are at the end now of the resolution planning phase, and so there's been a lot of work done, and I can mention that in our group we've run 10 dry runs on these exercises that the SRB wants us to do, and we are keen on making them. Dry runs on the bail-in dataset, which is necessary to have the data to bail in our liabilities. The dry runs on the valuation system, the financial market infrastructure, and we also covered other topics as communication, operational community, etc. So there's been a lot of work in this resolution planning phase, and now we are entering in a new era, and the new strategy of the SRB is welcome in that regard. And I think I would like to give some our point of view on the way these relationships with the SRB could be in the coming years. And these are summed up in the 3 Ps, the P cube. Those are the pragmatism, the proportionality, and the predictability. These are things we shared with the SRB for the strategic review which is coming, which has been announced. And so to give a few examples concerning pragmatism, there's a number of subtopics on which we discuss with the IRT to find solutions to have less heavy procedures on things like waivers, on recurring waivers on subsidiaries, which every year have to be done from scratch, and so we could perhaps think about simplification in that matter. Concerning proportionality, I mentioned the bail-in dataset. If we cover the entire balance sheet size with every liability in our balance sheet, we think it's a quite ambitious target. And so for now, we have a perimeter in that exercise which covers a lot more than 8% seal-off, and so technically, normally, if we have a bail-in in our group, we shouldn't go above this level. So we think the SRB could think about having a limited perimeter on these exercises. And the third one was predictability. So we have time now to enhance our system and our resolution tools in the banking system. We have to work together to have a step-by-step approach and to reinforce our systems in a pragmatic way and with predictability, because sometimes, I have to say, last year we had a liquidity exercise which was a little bit short noticed for the industry. So we have to work to better be prepared for these exercises. These exercises are, for some of them, huge investments. So we are making them to enhance our resolvability, and we have to talk together to have this step-by-step approach.
And that is a perfect way to end. Look at the time. Our timing is absolutely perfect. And before I hand back to Susan, I want you all to please thank our incredibly esteemed panel for joining us. Sean Berrigan, Manuel Preto, Annalie Tuominen, Birgit Rodolph, and of course, for stepping in at the last minute, Axel Marmonton. Thank you. Thank you. Susan.
Thank you very much, Joe, and a big thanks to all our panelists and our other speakers this morning. Now it's time for a well-deserved lunch break. For those of you here with us, lunch will be served in the Riverside area, and you can just follow the signs. We'll start again at 14:30, at 2:30 sharp, with our parallel sessions. So you can just follow the signs at that time to the room for the session that you signed up for when you registered. You will see signs directing you. As a reminder, the Emerald Journey session will be here, it will be streamed, and the other two will be made available via video after the session. With that, thank you very much and bon appétit.
Well, Sean, thanks very much. Thank you. I think I might.
Welcome to the new generation of jazz. Jazz. Jazz is simply super. It is a wonderful music. It is the classical music of the 20th and the 21st century. It is fabulous. That's jazz. Jazz. Jazz began a long time ago, and it's still alive and kicking. Very rhythmic, speak like this, jazz. Jazz began a long time ago. Very rhythmic, speak like this, jazz. And it's still alive. Jazz. The new generation of jazz. Forever. Jazz began. Jazz. 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 That's jazz. Jazz. Welcome to the new generation of jazz.
outer space.
Mornings took away my baby, leaving me with shame. While you're wandering the streets, I'm forced to wait here. My heart is in chains. Can you save a little love for me? Days became an expectation, driving me insane. What you doing while you're out there? Has anyone else managed to restrain you? Better save a little love for me. It's light around, but you can see me. I see you all the time. When the sun comes up, you're running as if you committed a crime. And I cry, save a little love for me. When you put your arms around me, I forget the pain. Tell me, are you thinking of me? Does my arms making you feel the same? Just save a little love for me. You go and you come and you go. What can I do to make you know that sweetest melody? Here and you there than you here. What can I say to make you not fear? Love is all I'm asking you to be. Mornings took away my baby, leaving me with shame. While you're wandering the streets, I'm forced to wait here. My heart is in pain. Please save a little love for me. Only at nights when no one is awake to see, you take off the mask, letting yourself be closer to my sweet melody. You turn and ask, save a little love for me. You go and you come and you go. What can I do to make you know that sweetest melody? Here and you there than you here. What can I say to make you not fear? Love is all I'm asking you to be.
Say, boy, what you doing around my jazz? You found the funk. Now you have to swing it. Swing. Jazz. Swing it. Jazz. That's it. Jazz. Yeah, you feel it in your heart. Jazz. Ah, feel your heartbeat. Jazz. Yeah, that's what the swing is. Listen to the jazz band funk. Listen to the jazz band rock. Listen
step off the limb now. That's one small step for man, one giant leap for mankind.
We're just too goddamn bad for each other. And baby, you make me so sad. I feel so incomplete. This one last time, you had me so bad. The pain is temporary. Ooh, we make it for ourselves. And it hurts me so bad, baby, to be away. But not like the pain when I stay. And I still love you, love you, love you, love you. Think I do. I'm caught up and confused. But this is it for me now, hey. I'm tired of being abused. So sayonara, auf Wiedersehen, my yara and the rain. And it just kills me, tears me up. But still I must confess, we're just too goddamn bad for each other. And baby, you make me feel so sad. What do you do for me alright? It's for a while, you hurt me so bad. But can you tell me where we met together so hard? And it hurt me where I could be alright. But you'll never come back. We're just too goddamn bad for each other. And baby, you make me feel so bad. And it hurts so bad to abuse. Hey, this one last time, you hurt me so bad. I still love you, love you, love you, love you, love you. I really think I do. But I'm caught up and confused. But this for me, I'm feeling like I'm being used.
what you were looking for when I saw you at the door. And I know you know for sure that I will be back for more. Do you wanna take a chance? Do you need experience? Take a look, take a glance. We're not just friends. Not just friends. More than friends. Not just friends. We're not just friends. Not just friends. Oh, I just wanna spend the night bathing in the starlight on a bench on the shore, so quiet. Fire on the inside. Let's start an avalanche. We could learn a little French. Why don't you let me dance? We're not just friends. Not just friends. More than friends. Not just friends.
that I'm a pro, but I can never seem to keep my control. I can't stand to take things so slow. Ooh, look at you, yeah, you're so smooth. Oh, when I'm around you, I can't keep my cool. Yeah, look at you, you're so smooth. Oh, when I'm around you, I can't keep my cool. I'm so used to getting what I want, or when I want it, and where I want it. When you feel that I'm experienced, so inexperienced. Oh, hey baby, I'm delirious. Ooh, look at you, babe, you're so smooth. Oh, oh, hey, yeah, oh.
is not Sally, and I am not cute. More than that, you'll find me in a terrible mood. But just because I'm bad doesn't mean that you're good. My head is too small and my mouth is too big. I wear sunglasses by the size of a brick. Just because you're the doctor doesn't mean that I'm sick. Doesn't mean that she's sick, that she's sick. is too long. My ears were made to understand things wrong. But just because I'm weak doesn't mean that you're strong. She's no good, she's no good, she's no good. So let's talk serious.
You can take the stage whenever.
Yeah, I go? No.
Yes.
Ah. Is it here? Yeah. So, good afternoon. I hope you had a good lunch. And we are here in one of the three panels, which concerns this one, MREL. So I am the moderator of this panel. I am Sebastiano Laviola, member of the Single Resolution Board, for those that do not know me. And I am pleased to invite, in order, Sofia Toscano-Rico. Please take a seat here, Deputy Director General of Horizontal Line Supervision, European Central Bank. Ruth Walters, Senior Advisor at the Bank for International Settlements. And two colleagues from the industry, Stefano Porro, Chief Financial Officer of UniCredit, and Gonzalo Gazos, Senior Director, Prudential Policy and Supervision, European Banking Federation. So, as you see, this panel is composed equally of colleagues coming from the institutions and colleagues coming from the industry, one representing a big European association, banking association, and a CFO of a big European bank. What we are doing here today, and why that? Well, first of all, you know, it has been mentioned today by Dominique, by several others, the importance of the requirement on a minimum requirement of own funds and eligible liability for insurance as a first pillar of resolvability. And what we have achieved in the Single Resolution Board until now. As it has been said, we have essentially arrived at 1st of January 24 at the fulfillment that the banks had to do of the target level, that's to say, the amount of resources that had to be ready in case of failure. And there are many other areas that have been fulfilled, so close of the transition period, the fund, the resolvability expectations, etc. So the idea is to take stock of what has been achieved, to also draw lessons, some initial lessons of the recent crisis, and a general opportunity then to revise, or not, the MREL policy in the future. For this purpose, we have published a short consultation paper in mid-December that touches various areas, and the paper is deliberately neutral, wants to provoke a debate and reflections from everybody, from the industry stakeholders, from representatives of the public sector, for other interested members. On what? On what we have achieved, the direction of travel, and whether there can be potential changes in the future. And there is no deadline, I say it from the beginning, it's not tomorrow, it is not in 10 years. It's something that has to be assessed, also on the basis of the feedback that we received. And the SRB has not taken any commitment to go in this or that direction. So I would immediately start, because the time is short, and in order to have more dynamics in this panel, I will ask to selected speakers some questions. So you will see that I will ask you, but then if there is time, others can jump in. The idea is that each of you speaks 5 minutes for the questions that you have kindly been requested to answer. I will start with the first one, where I would ask the ECB and the EBF to give us some views. And this one is the following. In our view, the final MREL target, as I said, has become binding and reached the steady state. We do not have, we are positive there are no banks except a few ones that have received the transition period, an extension of the transition period that are in shortfall. This will be confirmed with the data by end March, but our analysts have communicated as that already from Q3 of 23. So do you think, with this in the background, that the objective of banks being fully resolvable has been effectively achieved? And there are lessons learned about the MREL journey that took various years that we should consider, ECB and EBF. Please, Sofia, floor is yours.
Thanks a lot, Sebastiano, and first of all, thanks a lot for the invitation to be here and to discuss this very interesting topic. It's a pleasure to be here. And you just mentioned that most of the banks reached their targets, and I think that's first of all a good achievement. So it's going clearly in the right direction, and I think we need to also, when those things happen, to also mention it, and then I think it's an important milestone. And then you ask, is the work done? And from the supervisory side, the work is never done, so we can always continue improving. And one of the things that I would like to say is that, well, we have achieved the quantitative targets on MREL, and maybe now it would be good to focus also on the quality of MREL. So where do we stand there? We should continue assessing, and I know the SRB is paying attention to that. You just mentioned the consultation paper, also where there is mentioned to further assess the quality of the MREL stack. So are the instruments that are in that stack really available to absorb losses when they come and in a timely manner? So that's one of the things that we should look into. And as it was already mentioned also before, really trying to go more into the testing phase. So really see if a crisis would come from even from an unforeseeable scenario, would the MREL that is there available to absorb losses. The second thing that I would like to say as well is on the operationalization angle, so this one of the testing, and would banks be able to provide the necessary information if a crisis comes in a timely manner? This would be another focus of angle of focus that I would like to mention, and that I think it should be explored. Namely, the operationalization in bail-in that would have to be implemented on a cross-border scale. Would banks have the capabilities to, on a timely manner, give the resolution authorities the data that is needed? This is an area where also from a supervisory perspective, we still see room for improvement. Data aggregation, risk data aggregation in banks, and the timeliness, the speed that we would need that data, would that be available on a cross-border basis? And this would be critical to be prepared for a crisis. And then the last point that I would also like to make is the need for continuing strengthening the cooperation and coordination amongst authorities. We are doing a lot already there, both the ECB and the SRB, but also with our partners, international authorities in other jurisdictions. And I would mention this is not starting. We are doing that already for a number of years even outside the EU with our UK and the US colleagues in the TPLE. It was mentioned this morning, I think, by Dominic, but where we really think it's important to do testing and dry runs involving all the relevant authorities, and if possible also involving some banks. So these would be at least 3 areas where I think work should continue. We are still not there, and I would just like to also mention to finalize that one of the lessons from the US turmoil in March was that it is important to have MREL. I think the EU made the right decision on ensuring that all banks that could have, whose failures could raise any financial stability concerns should be earmarked for resolution and should therefore build loss absorption capacity and recapitalization capacity, and therefore also for medium-sized banks it's important to have it in place and implemented.
Thank you, Sofia. Now Gonzalo.
Thank you, Sebastiano, and congratulations for the event and the openness of the SRB in this new stage that starts after having reached the steady state. I'm not going to repeat what has been said this morning. We've come a long way, met very challenging targets, and also fulfilled some of the objectives, at least the most important ones. But now we need to take the framework to the next level, which means to make it more efficient, more simple, and at least equally robust. And I'm sure we can do that. I think Dominique mentioned this morning that it's difficult to improve something that is already working. It's a little bit what happens with the SSM, with this high-level report of the expert group, with many recommendations to improve something that is actually working. And that's maybe even more difficult than starting from scratch. But that will be a different story. Now let me tell my answer to your question, whether the objective of banks being fully resolvable has been effectively achieved. And I would say, you never know until there is a case, but I would say yes, or at least I can say that the 3 tasks we had to accomplish have been done effectively. First, the regulation. Second, the implementation by the Single Resolution Board with a strong determination because it wasn't obvious. And then the huge contribution from banks in different types of funds. So we can tick the 3 boxes because that has been done, and only hope that, of course, any bank would be effectively resolvable. Now, let me stop a little bit in these 3 factors. First, the regulation. Before this regulation, you will remember we had, and I remember with you, Sebastiano, we had the directive on the winding up of credit institutions that was reliant in the home supervisory scheme and then complemented with MOUs for voluntary cooperation. And it worked well in going concern situations, but it proved insufficient in the heat of a crisis. And that nuance is so important. Now we have a regulation with a clear roadmap what to do in a resolution of a bank, be it at national level or a cross-border resolution. Then in terms of what the single resolution mechanism has done, we have witnessed how the SRB and the NRAs have been working relentlessly to get everything ready should a bank have to be resolved. That's important. And I think that also makes a difference because in the past, every resolution case was an exercise of improvisation. And now we have a clear procedure to follow. And let me expand a little bit more on the 3rd factor, what is the contribution of banks. Of course, we know all these figures, but sometimes you stop thinking about what they mean. And we really need to appreciate the effort made for a very important purpose. The banks have contributed to the Single Resolution Fund, the original target of 55 billion, plus 22 billion euro on the way because of the deposit growth in the pandemic, making 77 billion euro. This figure, to put it in perspective, is almost equivalent to the yearly average net profit of the whole sector during the last 10 years. So that's a big sacrifice on the side of the European banking sector. Put together with the deposit guarantee funds at national level, plus the resolution funds, the bank-funded contributions amount to 2.4% of covered deposits. Just to put an example, and this is not to make comparisons, but you know, in the US that figure is 1.3%, and it's now been, of course there is the potentially exposed contributions if need be, but the funds that we have already put over the table is really massive. Now we need to use them for a good purpose. And I would also remark the speed at which this has been done, what has been also a big impact in the P&L of the banks. So we are very happy to have reached the steady state, meaning there is no more burden on the P&L of the banks, hopefully going forward, or not a lot. But the conclusion is that the banks in Europe are effectively resolvable using private money and resources from banks. That was the main objective when we all started with this project. Now, in terms of lessons learned from the MRL journey, I would say we have achieved the goals. The steady state is there. It comes at a big cost. The second lesson is the MRL calibration is robust, however, too complex, and we will speak about that later on. And third, let's not forget that even if we are now in a steady state, there's still a lot of regulations that will influence also the MRL and the resolution procedures, mainly the implementation of Basel III and the future macroprudential review that we will also need to take into account the impact they will have on the resolution metrics. I would stop there and go back to you, Sebastiano.
Thank you. Thank you. Contributions from my point of view. So now let's go to second question, and I would this time call again Sofia and Ruth to provide us some views, but also Stefano if there is time to jump in. So here, just to put the question in context, we have already spoken about the banking failures of March 23. This will lead to an evolution of the resolution plans and maybe also the MRL targets, we will see. Why I'm saying that? Because what comes out is that you know, the crisis evolve dynamically, and therefore the strategy has to be up to the task and it be used in that moment and has to be the best possible in that moment. So this calls, as the FSB report mentions, to consider a kind of you know, optionality on flexibility in the use of the resolution tools. This doesn't mean that the more optionality means a detriment to the preferred resolution strategy. So there will be always a preferred resolution strategy and a certain tool chosen. But this tool, in certain cases, according to the scenario, can be different, can be more than one. So it is also a combination of that. And we have seen particularly during the crisis, in resolution or in what has not been a resolution, but very similar in terms of results, a role for the transfer tools. And so here the question is whether we have, and this is the SRB, at least aspiration, intention to study the use of transfer tool, asset transfer tool, in combination with bail-in, with the bail-in tool. What is the impact on MREL? Because here this concerns the strategy. What is the impact on MREL? Well, you know that when there is a transfer tool, already the policy provides a rebate, so essentially a lower amount in the so-called recapitalization amount. Sorry for the technicalities, but it works like that. Now, clearly, depending on the size of the bank, it is unrealistic to assume that certain type of banks will only be resolved with transfer tools, because the sheer size of the banks probably doesn't allow that, and doesn't allow to find willing buyers. We have seen in the case of Switzerland that there is also an issue that has been posed of becoming even too big to fail again, because we have from 2 GCB, we had just one in a relatively small country. So, as I said, one potential solution would be to combine bail-in and transfer tool rather than, according to the scenario, and this doesn't mean that bail-in is not important and not useful. Bail-in remains crucial, I want to say it clearly here, but maybe to accompany that with another tool in a more, let's say, systematic way. And this would provide a greater optionality and greater operationalization of the resolution strategy. Now, what are the views about considering in resolution planning more than one resolution tool, or even a combination? And these can effectively increase the optionality in execution. Sofia and Ruth and Stefano, if you want to add something.
Thanks a lot, Sebastiano. Well, in my view, indeed, having optionality and flexibility is critical for the resolution authorities, because you are, of course, in resolution planning, trying to identify what is the preferred resolution strategy, but it's impossible to anticipate where the crisis will come from, what will be the trigger for the bank failure. And if, for example, the open bank bail-in is the preferred resolution strategy, and then there is a failure, triggered liquidity failure that is triggered by doubts about the sustainability of the business model, or is the bail-in tool the right tool? So I think that having optionality and flexibility is critical, and it's important to be prepared. So in my view, it would be really good to start looking at other tools and how to implement those other tools. And the transfer tools, as you just mentioned, have proven in the past, in the recent past, but also in cases like Popular or Sberbank, to be quite useful tools. In some cases in combination with bail-in or not. So. And we see that also in the US, the purchase and assumption tool is quite widely used. So in my view, to your question very directly, yes, I think it would be important to work on alternative strategies. Of course, this requires additional work, both from the resolution authorities, from banks, also from supervisors, because we contribute to that work. We are consulted on resolution plans. We are involved. But I think it's something that needs to be done. It should be done. I think proportionality is key here. So we're really trying to identify what makes sense for each case, and that's critical. And the thing is that for a transfer tool, it's not so easy to prepare into the detail, no? Because you can try to identify who could be potential buyers, but then depending on the crisis and what triggers the crisis and how the market is, how the other institutions are in the specific crisis scenario, it will be a question mark of who could be a potential buyer. And here is also where in Europe maybe we are not so well prepared as in the US, and we mentioned it before, the fact that we have a less integrated banking market also may reduce the possibilities of potential buyers. And we see that cross-border acquisitions prove to be more difficult and not really taking off. So that's another thing that I think we need to continue working on, to try to get a more integrated market that also can open the possibilities of a good exit in case of a crisis situation. And then concretely on the question on what would be the impact on MREL, you mentioned there is already something there when you have transfer tools as preferred resolution strategies. In my view, and this is a personal view, but I think that in most of the cases probably the solution will be a combination of tools. So bail-in, some kind of bail-in will not be probably out of the table, and therefore in terms of MREL, you need to be prepared for being able to take a solution that implies bailing in. So I think you need to be prepared for the most demanding resolution strategy amongst the ones that are in the toolbox. So saying that, and as you said as well, bail-in will continue to play an important role, and MREL as well.
Thank you. I would agree very much on the fact that if the market is not well integrated, if there are no domestic buyers, which is the experience that we have had in the past and recently, then clearly it is more complicated to find a buyer. So this is a further element of reflection to have a push towards a more integrated European market. And now, Ruth.
Thank you. Thank you for inviting the BIS to contribute to this incredibly well-organized event. I feel that I'm slightly superfluous here because, at least for this question, Sophia has said pretty much everything that I would have also said on this topic. Flexibility, yes, is crucial, but I think we've already seen that resolution authorities are flexible. We saw it last March. Credit Suisse, FINMA was in parallel preparing to do a bail-in. They had all of the legal instruments necessary for a bail-in prepared in English and German translations. They were working intensively with the crisis management group in order to make that work if necessary. In the end, they opted for something different. There's been extensive discussion of the reasons and the pros and cons of that, but we saw flexibility. Maybe an even more textbook case, the Bank of England with the SVB UK. On the Friday night, they announced that they would put it into a bank insolvency procedure on the Monday, if nothing else, but over the weekend worked running parallel strategies, preparing both for a bank insolvency procedure, but also working with potential purchasers for a resolution transfer. In the end, they got an offer that offered better prospects for depositors, for creditors, for the public interest, so went with that. But again, we're running both strategies in parallel over the weekend and ended up with a result that worked. So we've seen that resolution authorities are capable of being flexible. And optionality is the new buzzword perhaps in this space. It was one of the conclusions from the FSB post-banking turmoil report. But Options have always been considered. Every resolution that we've seen to date within Europe has involved some kind of combination of a write-down of some instruments to fund a transfer. So we're not in entirely new territory here. For obvious reasons, the focus over the past almost decade has been on making bail-in operational, because bail-in was a new concept, because it's technically difficult, because following the great financial crisis, the focus was fairly squarely on GSIBs and on the very large cross-border banks, where certainly a full bank transfer is not an option that we can rely on being available. We might get lucky, like the Swiss did, and find it, but it's certainly not something that we want to plan for. So the focus has been on making sure that bail-in was something that is practical, feasible, and we're still grappling with the technical details of that, and that work's going to continue. But factoring in other strategies into that makes perfect sense. But this doesn't come, this isn't costless, as Sophia suggested. It's going to make the work both for banks and for resolution authorities even more burdensome. Banks are going to have the capabilities to support combinations of resolution strategies or alternative resolution strategies, and the capabilities they may need to support a transfer strategy are there's an overlap, but they could be slightly different to the ones they need to support bail-in. So it does have resource implications for the banking sector, and be interesting to hear what the banking sector thinks about that. Equally, resolution authorities' playbooks are going to become even more complicated because they're going to have to deal with these. So this is something that we have to think about when it's not a free lunch here, but it's certainly something that needs to be done, because resolution authorities, you never get the crisis that you wanted. You never get the crisis that you planned for, and if you've only got one plan, then you're going to be left maybe exposed. And the other thing I wanted to mention is smaller banks. We've been looking at larger banks, but smaller banks. And here, I think loss absorbency is an issue, and this is something that the BIS, the FSI, has done work on the ability of smaller banks to issue sufficient MREL, particularly to fund transfer policies. And here we think that recognizing the possible contribution of the deposit insurer to help fund a transfer is going to create sufficient options for smaller banks. Obviously, MREL on balance sheet loss absorbency is always going to be the first line of defense. But in order, it's becoming generally recognized that certainly smaller banks, which may still need to be resolved because they could be systemic, may have problems at least issuing the debt-based MREL that's needed. So recognizing the contribution of deposit insurers can increase optionality here. The CMDI goes part-way towards this by the proposal to move towards general depositor preference, because that's going to increase the amount of the deposit insurance contribution to managing a bank failure. But we think there may also be an argument for allowing that contribution to be taken into account when setting the MREL for smaller banks, because that's going to, it's recognizing something which in practice is likely to be there, available, and it may make it more feasible for smaller banks to meet their loss absorbency and resolvability targets. We know that that's not in the Commission proposal at the moment. In fact, it explicitly says it can't be taken into consideration, but we think that if you're looking at making options for resolving, for transfer strategies for smaller banks, because a purchase is less likely to be a problem there, the problem may well be the funding of the transfer. So that's something that can increase options there.
Thank you. Thank you also for the proposal. Stefano, anything to add on this?
Yes. Thank you, Sebastiano. Good afternoon to everyone. So I would echo what Sophia and Ruth just said. Optionality in a crisis is fundamental, in whichever type of crisis. A couple of considerations. One is readiness. The second one is actionability. And the third one is leverage on what has been already done by banks, especially in relation to the recovery plan, because we need to be conscious of the fact that banks work and will work on recovery and a resolution plan. But I will be more precise in relation to that. What I mean is the following. So when we're referring to asset transferability, we need to take in consideration that banks in the last years work on playbooks, work on dry run, but work also on resolvability assessment, right, on one end. On the other end, we worked on the resolvability and so on, also on asset transfer tool. Even more on the recovery, right? Because when you look to the recovery, you look if you can sell a legal entity, if you can sell a portfolio, if you can sell a going concern. Now, which is the issue? The issue is readiness and actionability. What I mean with actionability? Actionability means that in order to execute, whichever of the asset transfer tool should be sufficiently tested in a way in relation to legal implications, financial implications, and operational implications, right? Especially in a multi-jurisdiction situation, right? And the more you go granular and the more you are adding complexity, the more the actionability is difficult. I'll give you a concrete example. If you are selling a portfolio and you have not sufficient information on that portfolio, you will be requested to have guarantees. Is the resolution authority already prepared in such a situation to give guarantees? Okay? If the answer is yes, good, you can have that. But in order to arrive to that level of details, you need to work before, right? And you need to be ready, right? So you need to have tested that, discussed that with the banks, and then you can include that in your tools. That is an example. That should be institution specific, right? Because depending on the institution, depending on the type of the tool, depending on the type of jurisdictions, the implication might be different. The other element that I told you is leverage on what we have, right? Because considering that some of this work is done on the recovery, as much as we can work on something that is already there for the recovery, the better it is. The last topic is clearly the incentive, right? So it's already there, but the more we can combine the buy-in with the asset transfer and the readiness and the actionability is there, it's clear that an incentive in relation to the MRO requirement is also very welcomed.
Thank you. Thank you. Good elements and food for thought. Now, let's move to question I would take together, also for reasons of time, question 3 and 4. So here we move to another aspect of the consultation paper. We have touched the potential optionality in applying resolution tools, so a combination of them. Here we move to an area which is how to reestablish market confidence after a crisis. And we have seen that some banks failed even respecting the capital ratios. And therefore, we need, of course, capital is crucial, but it is important to have various capabilities in resolution, for example, liquidity or positive assessment by markets and the bank's counterparties, particularly the bank's counterparty, that after the resolution and the financial restructuring will be put the bank back in business, and therefore there is a sufficient confidence in order to restart transaction as a counterparty with the resolved bank. So here all resolves about what is important and what are the factors underpinning market confidence in resolution. You know that we have a market confidence charge. Also for subsidiaries, not only at the point of entry, this is important, but also for subsidiaries, because normally in a standard SPE strategy, the loss absorption and recapitalization to the subsidiary is provided by the parent through the mechanism of write-down and conversion, etc. And so we have considered that a market confidence charge, what we call a market confidence charge, which is a buffer on top of the standard MREL, is it necessary in certain cases to ensure the viability of the subsidiary? For example, in our current policy, but we are thinking about how to improve that, if the subsidiary is deemed complex or strongly reliant on wholesale funding. Why I mention wholesale funding? Because these are the funding that probably are the first to run away in a crisis. So now these two questions are, what are the main factors that for a bank to be able to sustain market confidence during resolution, immediately after resolution, and instead for the MCC for the subsidiary, if we look at the allocation of funding, so the distribution of funding within banking groups, what is the experience with what we call in our jargon internal MREL for subsidiaries? Were there challenges? Yes, no, it is not a problem. Are there structural changes to the funding model of the groups? What are the views, particularly from UniCredit in this case, and then additional elements I would like to have from Ruth, if time allows, also from Sofia and Gonzalo.
Okay, so let's start from market confidence. When there is a crisis, something went wrong, right? And so in that moment, it's very important to understand what can restore the trust. And I would highlight that the main important elements are in this order: liquidity, capital, and profitability. But when you are in that situation, and as you have highlighted, there are different stakeholders, right? Because let's say there are banks, there are financial institution investors, there are rating agencies, there are other stakeholders, because there are also creditors, clients as well, right? That's very, very important. The first important part in order to cope with that is a plan. So it's very important to have a credible plan and a reliable plan to be communicated, because there was a loss of trust. So, and that plan should be properly, timely communicated. Not at the maximum level of details, but depending, let's say, the situation of the crisis, the level of information can increase over time. The communication of the plan should include different information. So, first one, liquidity. Which are the liquidity backstop there? Which is the liquidity sources that are there? Provided by whom? Will they be sufficient in order to address structurally the situation? And such a liquidity backstop should be there not only in the moment when there is a crisis, meaning at the peak of the crisis, but let's say also after, right? Because the situation should remain stable over time, okay? So when I was referring, it's not only necessary to communicate point in time when there is a crisis, it's because also afterward, it's very important to communicate maybe with further information and with different type of details what will be done. Liquidity is one topic. The other topic is, for example, management team, right? So how the management team will be changed, will not be changed, and so on. The capital and profitability is something that can be addressed afterwards, okay? In this order. So the very, very, very important part is liquidity. The second one is the capital by definition. From this perspective, I do believe that, let's say, the capital charge is more important for, in a way, viability than not for restoring confidence, because as we experienced in the past, we know very well that we experienced crises where the capital was not really the driver, right? So the driver was something different. And so that's what, and in some situation, if you have a higher requirement, you might also be perceived riskier by the investor community in a way. So that's why I don't believe that it's a relevant driver to be taken into consideration to restore the confidence. But after having addressed the liquidity, for sure, the capital level, that is very, very important. We discussed in this morning the topic of business model. Business model is also very important, coped with, let's say, the potential asset transfer implication. What I mean is, after having gone through a crisis, the third step is, let's say, properly communicate which is the new business model and the capacity of the, let's say, good bank, remaining perimeter, to be profitable and with the right business model. With the right business model, I'm giving for granted that at that point in time will be sound from a liquidity and capital standpoint, but also profitability standpoint. That's why I'm seeing this in this order. With regards groups and what is, let's say, the experience for subsidiary and so on. So one is, as much as possible, harmonizing the approach in relation to the instruments used. I'll give you an example. You can do internal management via loans or bonds. We decided to go with bonds. Because via bonds, you can apply a more standard approach. And bonds are usually instruments, and when it's necessary to deal with cross-border transaction, asset and liabilities transfer, are instruments that are more standardized than loans. It's very important to address specificities in the sense that if you look from the investor standpoint, the less specificities there are, the more standard there is, the better it is. As we know very well, in different jurisdictions, we might have slightly different laws, slightly different regulation. We've tried to be as much as standard possible in line, let's say, with the local boundaries, laws, and regulations. So as much as we can in future to harmonize also laws and regulation, the better it is. Confidence. If we are thinking on how to restore the confidence on the subsidiary, we go back to what I was highlighting before. And what is making the difference is the content of the information and the related communication. What I mean is, take a subsidiary. Restoring the confidence on the subsidiary depending on the resolution strategy of that group. That subsidiary is self-sufficient from a standalone perspective, yes or no? If yes, it's very important to communicate that, right? That subsidiary will be part of the new group or will be sold before. That's very important, right? If you are in a single point of entry, that subsidiary will be automatically capitalized, right? So will that subsidiary receive a further support? Even more support, yes or no? So all these topics are going back to what I was telling before. It's very important to have a plan, not only for the group, but also for the subsidiary, especially for the one that should access the market. And then progressively integrate the communication, not only in relation to what is important for the group, but what is important for the market or for the stakeholders of the specific subsidiaries.
Thank you. Now, Ruth, any other point to add on this?
Yes, I mean, I think coming second means I can be brief because a lot of the important points here have already been raised. Yeah, sort of you're exploring where the market confidence charge should be calibrated, and I think the flippant answer to that is your guess is as good as mine. But it needs to be robust. It needs to be sufficient to provide the operating capital, but also the funding that's going to be needed to finance the restructuring. And it's the restructuring that's going to have to be credible and going to have to be financed, and you know that could end up being expensive. FINMA already have indicated that had they bailed in Credit Suisse, they would have bailed in everything. The result would have been probably about capital at 44, or CET1 at 44% of RWAs, which is massive, but that's what they assessed was going to be necessary to be able to do to finance a credible restructuring of Credit Suisse, which, as we know, was a institution that failed not because it was its capital had fallen below regulatory minima, but because it had lost market confidence, because its business model was perceived to be flawed, because it was seen as a badly governed institution. So their market confidence, the MCC is really only the start of it, and has already been said, what is needed is a credible restructuring plan, the governance arrangements to support the delivery of that restructuring plan so that everybody can be confident that that's what's going to be delivered, clarity about who's in control, clarity about the new shareholders' rights during this period, a credible management team that the market is going to have confidence in, an understanding of what restructuring tools are going to be needed. So it's foreseeable that there are still going to be bad assets on the balance sheet. Those need to be dealt with, possibly through an asset management vehicle. That's going to be expensive. That's where your market confidence charge is going to be. Communication has already been said. This is going to be crucial, particularly in an area where we've seen that social media can accelerate a bank run. Social media may also continue to question a bank which has been bailed in. So there needs to be a strategy for dealing with that. And communication isn't just going to be a resolution weekend task. It's going to be a far more extended task, and there needs to be a plan for that. As already been said, so I won't labour the point, but liquidity is crucial. You have to assume that central bank liquidity is going to be needed immediately, but also in the medium term. And the fact of the central bank standing behind this newly bailed-in bank is a signal to the market that at least the central bank believes in it. So that's going to have a positive effect in and of itself. So I think basically the loss absorbency of the MCC is just the beginning of it. It can help restore the capital, but there's far more factors to credibility here, and it's the beginning of the question. It's certainly not the end of the answer.
Okay. So thanks. I would move. I'm cautious of the time, so I would move to the last question before opening the floor to those that want to put questions to our speakers or to myself. You know that in the consultation paper there was also a short paragraph on long-term policy considerations. That's to say, you know that the way that the MREL calibration is built today derives, of course, from the legislation, and there are various ups and downs, let's say, changes, adjustments that are made to take into account, for example, as we said, the market confidence, the balance sheet size, the resolution strategy in case of transfer tool, etc. So this is the way it is calibrated and built today. Derives from the legislation. It is not the most user-friendly methodology, as we know, but however, it is what it is. We thought that, said, why one day, not today, because there is nothing in the legislation that allows that, but why not to think about, in the long term, to something that would be to have an harmonized minimum, so equal for everybody, with only one adjustment, which is a kind of holistic adjustment for any type of modification that you might need, and that could be linked also to the resolvability assessment of the entire bank. So not only MREL, but also other aspects, so to work also in the sense of an incentive, no? In various directions. This is, as I said, it is not in the current framework, so would require a change in the legislation, and it is on a multi-year horizon. But so the question is, views, and this is for Gonzalo particularly, representing the industry associations in general, how do you assess the complexity of the framework, the calibration methodology, which type of simplification if one day, where possible, should be needed? Thank you.
A very interesting question. And of course, complexity is one of the common features of European regulation at large. And in recovery and resolution, it is even more complex because MRL is inherently complex. So it has to be. But then it also inherits the complexity of the framework where it sits, because the legacy framework of capital is also very complex. This is all because of the many buffers that have been developed during years in Europe. So I think if we want to be effective about simplification, we need to work on two areas. One is the MRL definition. I will refer to that in a minute. But before, on the buffers and the capital framework. And there is an opportunity now that the macroprudential review is going to be launched to reconsider some elements. That, by the way, it's now being done by other jurisdictions. So there are times for everything. At the beginning was the regulatory reform. We had to put a lot of things, and at the end, an unintended consequence is that the result is too complex. Successful, but too complex. Look, for instance, at the UK, the speeches recently by Sam Boots about this bufferati idea, meaning let's condense all those buffers into something that can be more meaningful. We need to work in that direction. Let me drop an idea. There are some buffers at the Basel level. We wouldn't touch those, or it would take a longer term. But we have this OC buffer that, by the way, in some jurisdictions has not been used. In Europe, we used it with a sizable amount in more than 180 banks. And then there is the systemic buffer at national level. And they are both meant to tackle systemic risk. There are nuances, but systemic risk, after all. And they are both subject to the discretion of local authorities. Couldn't we merge them and reduce them, by the way? Or if we are going to use them for future systemic risk, maybe we can use what we have already in the OC buffer. That's just an idea, but there are many others that we cannot review at this point. But then there is the question of the usability. This paper was very enlightening, the paper of the SRB that was drafted this year following another paper of the European Systemic Risk Board. And after reading it, the constraints between the capital framework, risk-weighted, the leverage ratio, and the MRL, it's a very interesting reading, but after that you think we really need to make this more easily understandable. So very happy to see it, because this will need time to define something that people, even bankers, we can understand. But one of the findings there was that the usability of the buffers that we have ranges between 30% and 70%. Put the other way around, all the capital that we have put there is only usable in the other part, in 30 to 70%, meaning there is between 30 and 70% of the capital that we put that it is lost for regulatory uses. So we need to work on making the capital that we put more efficient for the purposes that was meant. And then there is these solutions. The solutions that are suggested in the paper are about increasing the issuance of AT1 or Tier 2. That's easy, but it's more on top of what we have. And we think that we are already at a level that is way above the point of reference of the international TLAC standard in terms of MRL, and also in many banks. So I think we have a very ambitious level of capital and debt. And another point that we need to look at, that it might be a little bit overlooked in the papers, is the importance of the MDA. At the end, when the crisis of the pandemic, we made a question to the ECB when the ECB said, let's use the buffers. And my first question was, does that mean that you move the MDA level? No, we can't, because that's in the regulation. So we need to have a look at that, because you speak to investors, and it is the distance to the MDA level, and Stefan, of course, knows it very well, what really matters. We need to work on those aspects. And then the idea of a single adjustment driver is welcome, because it is an open question that we are not going to close in this panel, but it's interesting. However, let me say, it would need a governance to make sure that all authorities involved, the supervisor and the resolution board, that you work together. And if you put together the loss absorbing amount with the recapitalization amount and also review the market confidence, then there is an opportunity for cooperation to come up with a single measure. It would be a kind of pillar 2 assessment, holistic. After all, in principle, it's not bad. It's in line also with what the SSM is doing. But there should be clear conditions. For instance, Pillar 2 in the SSM was a success story in terms of converging from 20 different supervisory approaches, but again, it was too complex. And then the high-level group said, you need to simplify it. The SRB has the opportunity to jump to the second stage and come up with something that is holistic and simple at the same time, easily understandable by the banks, by the stakeholders, that it has to be also predictable by the CFOs, Stefano, so that you can expect what the requirement will be next year, and transparent and respecting the principle of proportionality. With those conditions, I think there is ample room to work on this proposal, and we look forward to engage with you on this topic. I'll have other things to say, Sebastiano, but I let you moderate, but if there's time, there are...
Well, since now, I think at 3:45, we have a coffee break before the final session for all the panels together. So the results of the panels, the three parallel panels. I would like first to open the floor to participants to see whether there are questions from the audience, and then otherwise we can continue for a few minutes. So are there any participants that would like to make a question to our panelists today, or on the consultation paper in general? Raise your hand so that the microphone can arrive to you.
Well, I'm here. Sorry.
Here.
Jean Postwick, BNP Paribas. Thank you first for the consultation, which is really welcome. And the industry, I think, is very happy with that kind of consultation. Besides that, well, let me seize the opportunity to raise the question about the existing policy for banks whose resolution strategy is based on transfer, where your policy anticipate a reduction of balance sheets for the recapitalization amount by something between 15 and 25%. Why are you taking that into account for mid-sized banks, basically, who may not have any subsidiary ready to sell? And why are you not doing the same for large groups who have subsidiaries that are easily separable and easy to sell? Especially if you combine the tools.
Yes, thank you. It's Eduardo Vela from BBVA. The question is very similar to that one. We are convinced, and we were very happy to see the combination of the transfer with the bail-in, because probably that is what in real will happen. Sometimes when we think in our case, we say that if I were the resolution authority, I will sell before making a bail-in, and after selling, let's see how much bail-in is needed. So at the end, it's a similar question. I mean, this is something that at the end will be the real situation, so it should be the one used to calibrate the real MREL needs on this transfer, because in our case, multiple point of entry, we have multiple choices to sell different subsidiaries ready for that. Thank you.
So again, the question. SBMP. So we cannot hear very well from here, but the question, as I understand, is, at least for the second person, is on, if I understand correctly, if there is a possibility to have SPE and MPE, I mean, together as a strategy, or one the variant of the other. This was the question. But selling subsidiary as part of transfer strategy, these in principle can be done. Well, there are some constraints in the legislation, but if it is a complex which depends in an SPE strategy, depends directly from the parent company, in principle, it can be done. So I would say that the difference between an SPE and an MPE, where you have, different subgroups in the MPE which have to look for funding outside of the main group, so independently of the parent, and there are very few interconnections, if at all, so the subgroups in an MPE have to be resolved by themselves. The difference is exactly the fact that the funding, and therefore any losses, even in selling, in the case of SPE, in selling a part of the subgroup, they all have to go to the parent company, because that is the single point of entry. While in an MPE, this works by definition in a different way. So this is the main difference, I would say. It then depends on the real situation of the crisis. But the fact that you have an SPE and that you cannot sell at all any subsidiary in resolution, well, it is not something that has been written anywhere, but it might be possible if viable. And in any case, in the restructuring, when there is a restructuring after resolution, normally there is a restructuring plan and probably changes in the business lines, and therefore probably some changes in the composition of the group. So it is a question to be effectively prepared, and eventually, if it is possible, to have this selling even anticipated where possible. But of course, it has to provide value in the direction of having the entity that remains to be more resolvable and to be viable after resolution.
No, that's clear, but I think that we were making very similar question. In the case, regardless you are SP or MP, you have a valuable subsidiary that could be sold as a part of a transfer strategy. On top of, we have the bail-in tool as the main resolution tool, but this should be considered. I mean, this is, at the end, it's the first part of the consultation that you are making. The combination of transfer strategies, I think it's a good idea and opens this kind of discussion. I think regardless if we are single or multiple, the thing is that we do have a good business that can be sold. And if that business is within a subsidiary structure, it's easier to consider and to calibrate than the umbrella having that or bearing that in
But you see, I would say that if a subsidiary, as I think UniCredit said, if a subsidiary is an integral part of the business model and of the viability of the group, it will, in an SPE model, it will be kept and will be funded by the parent company until the end, because it is part of the business. So I don't see that as a yes, no, or a black and white situation, because in a crisis, you have to assess what effectively first preserves the value for everybody, and particularly for the original group, and what is more possible to be performed. So I wouldn't be so dogmatic on that. But then if you are to infer that, but then if I sell, then I don't need loss absorbing capacity, etc., that is another question. Because ex ante, you have to be prepared, because we don't know what will be the likely scenario that will materialize at that moment, at the moment of the failure. And therefore, there can be cases where you have to adequately capitalize the subsidiaries, particularly if they are important in the local market, or if they develop some business which, as we said, it is complex, or it is subject to more shocks of market confidence.
Well, if I may come back to my question, and I hope you will hear it. Well, my question was similar and some slightly different in the sense that in the current MREL policy, when a bank has a resolution strategy that is based on transfer, you consider that for the recapitalization amount, there is a reduction of the size of the bank by anything between 15 and 25% in any case. While normally those banks that have a transfer strategy as resolution strategy are generally relatively mid-sized banks, not that large ones, that have barely any ready-to-sell part, that have barely any market activities that would anyway reduce. So by the fact simply of their deterioration of their situation, whereby the counterparties would reduce their business with them, while for large banks, obviously, for large banks, well, they have plenty of subsidiaries that can easily be sold, that are not necessarily linked to their core business, and they have market activities that by definition also will naturally reduce if their situation deteriorates.
My understanding of the question is that you would like the resolution authorities to declare ex ante, depending on the type of subsidiaries, what could be the treatment at a certain point. But these, first of all, it is case by case because it depends on the business model and the strategy chosen for that particular group. And then, as I said, it depends on the strategy that you are putting in place. Therefore, while ex ante you do the best for your preparation for what you think that it could likely happen, as we said today, we believe on the basis of the experience of crisis that we should have even more flexibility, which implies also that if I combine certain tools, this doesn't prejudge the fact that at a certain point I could have a different business shape and size of the group at the moment of resolution and immediately after.
Sebastiano, I don't know if you allow me to complement what you've just said, but to be very, very simple, for the moment, 80% of the banks are under a bail-in strategy, full stop, bail-in, unique tool. What we are saying today is that we are ready to analyze a possibility to combine with other tools. And let's do it step by step. As we've said, I think Sofia was extremely clear about the level of preparedness. It implies a number of things, and there is no free lunch, as you said. There will be a number of steps to take. If we say we want to combine tools, we want to be sure, based on your recovery plans, but not only, that this separability is in place. That's to say it's not enough to say that we can sell a subsidiary. We want to do it. Under full bail-in strategy, we have several weeks to prepare that. This is the restructuring plan. If we say that during the resolution weekend, we want at the same time to implement a bail-in decision and to transfer a part of the perimeter of a failing bank, it's another story. So we are not immediately ready to consider the implication on the MREL policy, but this is exactly the topic. Once we've addressed the question of combination of tools, we'll go to the translation in terms of MREL policy, obviously. But we are not yet there.
No, we are not yet there for sure. And therefore, this implies a lot of preparation ex ante and to assess whether the eventual combination of tools is credible and feasible. And then there will be a reflection on the calibration eventually. I think that it is time. You wanted to add anything else, Gonzalo? Yes?
Taking advantage, there is still 1 minute, Sebastiano. We didn't mention the term bridge bank yet. And that would complete the discussion, because I remember in that meeting, the Commission in the Berlaymont, like 2-3 years ago, is a question that I raised to you when you were in the panel, and we thought about that. And it's like one of the hidden possibilities there, because of course we talk more about transfers, but just to drop the idea, there is an objective of the banking union that has not made progress, what was the cross-border banking consolidation. And the bridge bank could be the tool that could give sufficient time for the interest of cross-border banks in foreign banks that is unthinkable in a weekend. And there is also the Financial Stability Board key attributes that contemplate the possibility of temporary funding by authorities under very severe control by the resolution authority. So the elements are there now that we have a very high level of bail-in. Without the bail-in at that level, it would be very risky. But now that we have it, if you put those three elements together, that's something we might have to explore as well.
Well, this is certainly a point that we have to reflect upon and consider. But for the moment, we are where we are. I think that I have to say, also taking the views from this panel, but we will discuss the results soon after the coffee break. It seems to me that the main points emerging here from the participants to the panel is that Sophia said, yes, we have done a good job of supervisory and resolution authorities and the banks, but clearly there is something in implementation that we have to be ready for in terms of information, of cross-border availability, also of collateral, for example, so there is room for improvement there. And in this shift from planning to testing, also the authorities are doing their job. Not only we ask to the banks to do that, but as has been mentioned by Dominique, by Sophia, we are also doing a number of exercises of different type of simulation with other foreign authorities outside of the European Union in order to be ready for different type of events. On the optionality and flexibility, there is to me that there seems to be a broad agreement, and then clearly the devil is in the detail here. There is a particular point stressed by UniCredit regarding the actionability that has to be tested, so leverage on the recovery plans, but also actionability of the strategy on the tools in terms of legality, economic rationale, of what you have in mind to do. And instead, as concerns market confidence, I take the view from UniCredit that first, I would tend to agree, at the beginning is immediately the important thing is liquidity, then comes capital, of course, for the viability of the business ongoing, and of course the business model that has to provide enough profits in order to be credible in the medium to long term. The EBF mentioned the complexity of the macroprudential buffers and the possibility to reconsider them, simplifying maybe the framework, and also to work more, but without increasing the overall levels of requirements on the usability of buffers, which today is clearly, as we know, and analytically shown, not 100%, but lower than that. From the floor, I think, came questions regarding the different flexibility needed depending on the articulation of the group structures. As Dominique said, clearly we have issued this consultation paper to get your views, but clearly before we speak of impacts on MREL calibration, this means to have credible, if that is the route, combined tool that can be applied. Thank you.
Thank you very much. We'll be back here in this room at 4 o'clock after the coffee break. Thank you.
welcome back, everyone, both you here in the Egg and those of you joining us online. I hope you enjoyed the parallel sessions. We're going to find out now in our closing session what we learned this afternoon with our SRB board members. So let me invite them to the stage. Vice Chair Jan Reinder de Carpentier, board members Sebastiana Laviola, Pedro Machado, Jesus Serena, and Tria Tawas. And our chair, yes, a little sprinkling of... And our chair, Dominique, is actually going to be the moderator for this session. So over to you, Dominique.
Thank you very much, and thank you to be still here with us after this long day. As you've seen, we've started this new setup with different panels, and here that's the right moment to do two things. The first thing is to come back to the lessons we've learned from these panels, and this is exactly what we will do in a minute. But there's another lesson, is to show you the permanent board members of the SRB just in front of you, all together, working as a team for, let's say, building again this famous resolvability and this resilience we are working on day after day. So I cannot invite all the staff members of the SRB to join us on the stage, but we are much more than 6. But at the minimum, you have the 6 permanent board members in front of you, and I think it's a good occasion to show you that we are all working for the same goals. So with that, let me start to come back to the different, let's say, panels, and there was one on MREL, and I would like to ask you, Sebastiano, to come back to this MREL session you moderated, and could you please share with us, with all of us, including those online, the main conclusion from these discussions?
Yes. Thank you, Dominique, and thank you to all the panelists. I have taken the opportunity in the break to put it here in my mobile. So the first takeaway, it is that building up MREL from the industry, it has been a demanding journey. We have now reached a steady state, and now it is more improving at the margin, the system, than that is working already. As concerns our proposal to reflect on optionality and combination of tools, all agreed that optionality is key, which clearly needs preparatory work and options that are fully actionable. This was particularly stressed by the industry, and therefore important to leverage on the work banks have already done in recovery and resolution planning, but this has to be done also in cooperation with the supervisors. For market confidence and building confidence in a crisis, another aspect of our consultation, communication is very important. The first element, however, is liquidity. That's to say, communication on adequacy of liquidity. After this comes capital, particularly to ensure the viability of the business model, and of course, adequate communication to investors and depositors on the future of the business model. However, in these strategies, to find buyers, we need a well-integrated banking market. And here, we have still probably something to do, because if we have only domestic investors as potential buyers, clearly this restricts the area of possibilities, and this is a call for completing the reforms of which we have been, which we have heard talking about this morning. On the complexity of MREL and future revisions, well, here it has been said that simplification is an important goal to foster consistency between the supervisory and resolution framework. In particular, the EBF asks for a framework which is simpler, more efficient, equally robust, and particularly mentioned as examples the complexity of the macroprudential buffer, mentioned also a document, a communication from the Commission, from FISMA, regarding the macroprudential buffer, the issue of usability without increasing, however, the size of the buffer, and the complexity of MDA and MDA. Finally, I think it was agreed by everybody that in order to have some impact on calibration of MREL down the road, we have to first work on credible and feasible combination of tools. Thank you.
Thank you, Sebastiano. I was attending this panel, and if I may, I would add one or two elements listening to the debate. What struck me was essentially twofold. The recognition that MREL is still something which is needed, and I think it's acknowledged by everybody, as you said, with some other topics which are even more relevant depending on the type of crisis, liquidity, etc. But still, MREL is something which matters at the moment of a crisis. So it should be obviously ready ex ante. But what we've discussed longly is many other things than MREL in itself. That's to say, quantity, quality, location, and transition period. For those who started studying this story of MREL a long time ago, like me, you remember perhaps that we spent hours and hours and hours, weeks and weeks and months and years and perhaps centuries discussing always the same topics: quantity, quality, location, transition period. More or less all these things are now in place, and what we've said already this morning, since this morning, is that in reality the build-up of this MREL stack is more or less in place now, and that's why the debate was largely driven by other consideration. Indeed, operationalization, readiness, capacity to check what Sofia Toscano called the qualitative side of the things. That's to say, the capacity to implement at the right moment, the right decision, etc., etc. And this is exactly what we want to do via this strategy. The second element, which was mentioned by a number of, perhaps not a number, but I noted this one because I think it's important. To those who think that the journey is done, the answer was clearly by yes and no. Yes, we've built this first element. Let me remember that as a mean, we have now 27% of risk-weighted assets as MREL, but no, because things are changing, and first from, let's say, the resolution side, and the combination of tools, if it is developed, could bring a new way of thinking the calibration of MREL in due time, once we've taken all the steps for that. So this is one. But two, the rest of the regulatory landscape is evolving. You've mentioned this macro-prudential reform, but there's also the Basel III one, which is coming, and there will be an impact on the calibration of MREL, let's say mechanical impact, but we need also to take this into account. So the MREL calibration is also depending on, let's say, not only internal factors we are working on, but also external factors which can have an impact. And I think that means that certainly in the coming conferences, we'll be able to continue to have some panels on the MREL policy, definitely. Let me go to now another session, which was about the new and emerging risks and how we can tackle them. So it was for you, Jan Reinder, to moderate this panel. So could you tell us what you took from the discussion?
Yeah, thank you, Dominique, and happy to do so. Difficult, I would say, to summarize such a discussion, but some highlights perhaps from my side. I think, of course, there was a discussion around the things that were also discussed this morning: the speed of information flow, the need for rapid action and thorough and coordinated communication, but also something like the war on talents, so where we all see that, to mitigate new risks, we're talking very much about digitalization, cyber attacks, but also other risks where there is a need to find the right experts. And banks, financial institutions, but supervisors are all fishing in the same pool, which is posing a risk on itself, and also the need to train staff basically to become experts in digitalization and related topics. Another element that I found very interesting was this, what was called so-called a polycrisis. situation that we see emerging more often. What does that mean? You know, we had Professor Singh of Warwick University explaining, saying risks are coming more and more together. So if you think about an environmental risk, for example, you know, and a natural disaster, sometimes you see it combined with an increased level of cyber attacks, because, you know, those behind those cyber attacks are taking the advantage of a natural disorder to basically try to influence the news and create more chaos at the same time. So these kind of things can come together and start to enforce each other, these risks, which I found a very interesting but also very worrisome situation. Perhaps, if I think out loud, the last thing that I could share with you is, you know, what was called a need to control social media. So this morning there was very much this conclusion, like we cannot control social media, but still I think in this panel there was definitely someone who was saying, but you need, you know, if you are in a deep financial crisis, you will have to find ways up front to have understanding with platforms of social media to make sure that this information is telling the truth and there is no so much opportunity for fake news to be spread around. I'm not sure that this is the answer. I'm also not sure whether and how we get there exactly, but I think it was a very interesting view that was shared during our session. So let me stop here. Thank you, Dominique.
Thank you, Jan Rind. Definitely fascinating remarks. But Jesus, you were attending also this panel. So perhaps any other comments and reactions from your side?
Thank you very much, Dominique. To be very frank, I got scared because there was cyber attacks, ransomware, disruption, social disruption. So I got a bit afraid. So I think that the panel did a very good job in raising awareness of these emerging risks that are really material. But fortunately, our 3 R's come to defend us or to protect us. One is risk management. It's not exactly the one we have some of the conference, but it was risk management, the importance of risk management on the side of the banks. The second was recovery, which is close to our operational risk continuity. And finally, it was resilience that is in our title. So I think that overall we have a long way to cover, but still we have the tools and the plan to tackle this issue. There was, Jan has mentioned, just to show that we listen to the industry, in particular to Axel, the 3 Ps this morning. Jan has mentioned 1 P that I was going to mention, polycrisis. But the other is a plea that I've heard in the session for simplified reporting and unified reporting. And I think that this is not on our hands, but it's something probably that merits some reflection from our side. Thank you.
Thank you very much, Jesus. A lot of food for thought, definitely. Let me go to the third panel, which was about testing, making resolution plan operational. So this is at the very core of the new strategy, as we presented it this morning. And so, Pedro, you were chairing this panel. So could you tell us the way the discussion went during this panel?
Sure. Thank you very much, Dominique. I think it was a very rich panel in terms of the discussion. There was a very interesting mix, both in terms of experience and also expertise from a banking union bank, a bank outside the bank of the European Union, but with an important subsidiary at the banking union, and representatives both from the one from the EBA and the other from the Central Bank of Ireland as an NRA. One of the main features that was stressed was precisely that we are not, as you said at the very beginning of this conference, on testing and operationalization. This is an evolution and not a revolution, in the sense that we are going to build up also on the experience thus far gathered, thus far advanced by banks in terms of testing. So what clearly was one of the main sort of drivers, but also wish list coming from the industry, is predictability, and in that regard the commitment is laid on at the level of the multi-annual program. So there is a commitment that we are going to adopt a multi-annual program which will clearly mark the path towards testing and operationalization to reach the end stage, the desired stage in terms of readiness by banks. So in that regard, this was very much appreciated in the sense of getting that predictability, which is, but we had also 3 Ps. So we had this morning 3 Ps, we had additional 3 Ps which are on prioritization, patience, and profitability. Profitability was an interesting area of discussion because it delves into the sort of continuum driver for the industry. What they would like to see is that also the investments that are done on business as usual might also be leveraged for resolution. And in that regard, I think it's sort of one of the takeaways that we get from this panel, which is interesting to sort of digest and reflect upon. But it was also on the discussion in this panel, much emphasis was also put on the dry runs that are led by the SRB, and on that to leverage precisely also on the experience that we have thus far gathered, but also that the NRAs have also done at the basis of with LSIs. And in that regard, this sort of experience going forward, there was clearly the sort of ambition, or at least it was much discussed, that we should deepen a bit the footprint, not only on those dry runs, but on the complexity of the dry runs to bring it closer to real life cases that we might be facing. So in that regard, I think that was clear. And then I think one interesting aspect that is also common to a bank sitting outside the European, headquartered outside the European Union, but also from the perspective of the EBA, is a certain asymmetry that might exist in terms of the testing progress across the board, especially for the cross-border groups. And that is something that we should clearly pay attention to. In that regard, that we keep an eye that testing is not very much advanced at the level of the banking union part and less advanced in other parts. And so that sort of concern should clearly be underlying going forward. So I think all in all, this was the sort of main drivers, main key takeaways, although the discussion, as you might imagine, was much more richer than I can even sort of summarize in this brief minute. Thank you.
Thank you, Pedro. Very rich discussion, apparently. Tuija, you were attending this panel. Do you share the view that it was really an interesting and rich panel and a rich conversation?
Yes, yes. It was interesting, and I can try to complement something what was already said on what was said by Pedro. I think on this topic we need to understand, of course, that we are not starting from scratch. So banks have many years experience of organizing, for example, bail-in dry runs. But during next years, we will organize, and banks will organize, more complex tests with different kind of scenarios, and test also transfer strategies to ensure the flexibility of our toolkit. And one panelist was mentioning that they are planning to test also their internal governance arrangements in the bank, and also test communication, which is has been stressed in this conference as a very important topic. So testing is an important element of increasing our preparedness, and one important message which we got, I think, Pedro, was that at the SRB we need to remember to use the synergies from different kind of tests what banks are requested to do. Also because of supervisory authorities are requesting them to do a lot of tests, for example, on operational resilience. So this was a clear message to SRB.
Okay, so as you see, the number of topics we've tried to address via these panels and the number of ideas we've collected are extremely high. And this is exactly what will charter our next month and our common strategy. We will pick up these ideas and look at them seriously to embed the lessons and the potential avenues for developing more our approaches for a better resolvability, definitely. So thank you for these panels, which are bringing us so much food for thought. Perhaps now, before closing this conference, perhaps it would be good to think about what we've discussed all along this day, and the best thing to do would be perhaps to reorganize a quick tour de table, if I may say so. There is no table, but okay. About your first, let's say, feelings, reactions about what was discussed, what was introduced, presented, defended. I think it would be interesting to know what you've thought about the content of this conference. Tuija, may I start with you to give us your first feelings?
Thank you, Dominic. Yeah, I think for me and for the whole SRB board, this conference has been very helpful. As it marks the start of the new phase of SRB, where we focus more on testing and more on operational crisis management capabilities. And I also enjoyed this conference because we focused on future, on long-term issues and new challenges. And for me, after this conference, I think it's clear that even clearer than before, that closer cooperation between authorities and banking sector is needed even more than before. And if we really want to make progress, and I'm pretty sure we all want to make progress, so we need to think about the future as an iterative common learning process where we test and then we draft processes, analyze, and then we test again, etc., etc. Thank you.
Thank you. Very, very good conclusion, I think. Stronger cooperation, that's an interesting one, definitely. Sebastiano, for you, any additional ideas?
In my view, the morning was very, very rich, and I think I found myself in this, not only in the comments and reaction from the, let's say, the public side, from the institution side, but also on various statements that, by the way, confirmed what comes as a feeling from the institutions. I believe that, this resolution framework, if I may say so, that, as you said, Dominique, is still relatively young with respect to other framework existing since many years. It is now, I believe, quite well understood, and although complex, it is accepted, and I think that the route, the path that done until now, where we are, as you said, that has been declared in the intention of the SRB to move from preparation and to arrive at a certain steady stage from the initial stages to now move from planning, so shift from planning to testing, to operationalization of the tools, to eventually reconsider what new elements these improvements might also build to the revision of the MREL policy, plus the other aspects that have been mentioned in the various panels. I think got a certain support also from what I heard from the industry, and therefore I think it is the path that we have to follow, the way that we have to work. Thank you.
Thank you, Sebastiano. Definitely valid remarks. Jesus, for you, anything to note from this conference today?
Yeah, thank you. Thank you. Maybe, if I may, to broaden a bit the scope. First, thanking you, Dominique, for launching this strategic review. I think that this has been a key issue, and also I need to say that it was very, very demanding. So we have been almost the whole last year working on the strategy, and I would like to take the opportunity to thank all our staff deeply involved in the strategic review, and also staff from the NRAs that have helped us a lot. So this is one thing. For me, more on the personal side, and a strategic review is a kind of soul-searching exercise. And for me, the driving question has been, what if, how would look like the SRB if instead of having a resolution every 4 years on average, we would have had a resolution every 4 months, or for the sake of the argument, every 6 months or every 12 months. So I think that our resolution plans would be different. They would be shorter, but more importantly, focus on what really matters, focus on testing the procedures and making sure that the data that we need for resolution is there. Probably we'll have less theoretical discussions on the preferred resolution strategy and more discussions on what we are going to apply the day of the resolution and what is needed the day of resolution. And with 8, 10 resolutions, probably we'll have a much better idea of how much MREL is needed to deal with a resolution. On our side, we want always more MREL. On the side of the banks, always less MREL. But we'll have at least empirical evidence, real evidence of how much is needed. Not to mention the issue of how much subordinated MREL is needed. I think that could be really useful. Access to the SRF would be well oiled, and I think that would be assumed as a normal tool to fund resolution if needed. But I think that it is not only a reflection for us, it's also for the NRAs. And you mentioned this morning, Dominique, on the national handbooks. I think that we would have very well-oiled national handbooks with clear procedures to launch a market-accelerated process, how to set up or already set up a bridge bank, and an asset protection scheme. So these are the things that we need to move into. So on the practicalities of being able to resolve banks. But I think that these changes are not only for resolution plans. They need to percolate the whole institution for crisis preparedness unit, from legal, from internal procedures, and obviously for human resources in terms of our retention policy, our mobility policy, so everything. So we get very well-motivated staff to deliver on our main mission, which is financial stability. So again, thanks, Dominique, for launching this strategic review. For me, this is really the opportunity to bridge the gap between what we have, that is a lot, to something that is more ready for a crisis immediately and to protect financial stability. So thank you.
Thank you, Jesus, for these very nice comments on what we want to achieve in the coming years. Pedro, on your side, any reaction on this conference day?
Well, First of all, I think it was a very rich day to start with. We start very well. I liked very much the venue. I think it was a big change, and in particular the socializing area. But more important than that, or at the same level of importance, I think we started very well with a key driver for dealing effectively with crisis management, which is also the cooperation with the supervisor. So I think the fact that there was this joint panel, joint exchange with the SSM, between the SSM chair or supervisory board chair and the SRB chair, I think demonstrates that the sort of continuum is key in driving effectively crisis management and safeguarding financial stability, not only in the area that it offers per se a continuum like the interplay with the recovery options, but and of course the further assessment in terms of the situation of the banks, but also in terms of the emerging risks, because for us it's key to understand to which extent we have to also embed further optionality in the banks in the face of these emerging risks. So that is key for us to be also successful in handling a crisis cases. So I think we started very well with that, and I think then we progressed well in terms of the further sort of readiness that we have to achieve ourselves, where the sort of leg of the banks and the progress by banks is essential. I think we ended up with a key takeaway that I would also like to echo is the acknowledgement that resolvability in itself is also an asset for the European banking sector. And it is also a key driver for financial stability in terms of market perception, of riskiness of the banks. So in that regard, this was also acknowledged. And as a sub-asset, I would say that testing and operationalization, so that this investment that also the industry is called to do also makes sense. That not only is the investment on MREL, because this pays off in terms of the loss absorption capacity of banks, but also on the other dimensions of readiness, on resolvability, that this also pays off in terms of market perception and ultimately to ensure financial stability. Thank you.
Thank you, Pedro. Relevant remarks, definitely. And anything to add from your side, from your perception?
Thank you, Dominique. I think it's difficult to add. I concur with what has already been said. Let me just say I joined the SRB in 15, and I think indeed now the phase of implementing this new strategy is extremely important. That we're really moving forward as an organization, going to the next level, if I can call it this way, is quite a momentum. So that I think for me is one of the highlights. Secondly, with building a bit on what Pedro said. We are living in a rapidly changing environment, and as a resolution authority we have an important role to play, but this can only be done effectively in close cooperation with our stakeholders, with supervisors, with national authorities, with others, but especially also with the banking industry. And this for me was one of the main elements that was kind of constantly repeated in discussion. Rapidly changing environment requires close cooperation, a lot of challenges ahead of us, but also many opportunities. Thank you.
That's true. That if we think about what we've discussed, it's exactly about, let's say, permanent changes. We've seen that risks were evolving, changing, new ones or evolving ones. We've seen that the regulatory landscape is not finished yet. We received a strong message from Mary McGuinness about finishing what is started and not yet finished. And so that means that at the end, this organization needs to be as nimble as necessary, as agile. And we've mentioned flexibility, we've mentioned optionality, but it goes beyond the tools, the toolbox. It means also that we, and you said it, Jesus, very well, our mindset should be sufficiently agile to go from the pre-envisaged schedule potential source of crisis or for a potential way of addressing the next crisis to come, to a new area made of new risks, new tools in an evolving landscape with new type of banks, type of risks, type of regulation to implement. And this agility, this way of being able to still, let's say, answering our request for more financial stability and at no taxpayers' money cost, obviously, is exactly at the core of the strategy we have presented you today. That's to say, we want definitely to stick to the real evolving life we have to address under our responsibilities. And this implies a lot, as we've seen this all along the day. So thank you for all your insights, and thank you for attending this meeting. Before we close, let me again thank all the speakers today. Let me thank you, the audience, to be still with us, listening carefully to what we are telling you, online and in person. Thank you for your active participation in the panels. Thank you for your contributions, definitely. I would like to thank also the organization team here, and I think we can make an applause for organizing this. For organizing this this day, and to finish the day, what can I offer you apart from let's share some drinks together? So thank you very much. Thank you for attending this meeting, and we hope to connect with you very soon. Thank you. Goodbye.
In the morning.